I think we do have this precious grant of independence, and that really means that we need to stay in our lane and just do those things that Congress assigns us to do. If we're going to roam all over the landscape, then we shouldn't be independent. We should be part of the elected branch of government. So that means we stick to our knitting, I would say. We do have, though, we have tools that can be used in the financial system only in emergency situations, such as the global financial crisis of a decade ago, such as the pandemic. And those tools can only be used now with the approval of the Secretary of the Treasury. This is under statute passed by Congress. This is under Dodd-Frank. So we do use those tools, and they're very powerful, but they have quite a limited use. And again, only to be used in unusual and exigent circumstances with the permission of the Treasury Secretary, who, of course, is part of the administration. So I think we need to stress, and we try to stress all the time, that we have tools that we can use, but they're not for general times. Particularly now, what I would say is that the tools that we're using now are lending tools, not spending tools. So we don't have the ability to make grants of money to particular groups of people, no matter how directly they're affected by, or companies affected by the pandemic. That is a job for elected officials who control spending and taxation. It's not a job for appointed officials like us. So there is a need to underscore the limits of our powers, although our authorities are very strong. And at a time like this, you're seeing how strong they can be.
One of the ways to draw a line between lending and spending, as you just put it, is to make, let me say, only loans that will be paid back. We might say with 100% certainty, if there was such a thing in the world. That's generally been a dictum of the Fed. You've been directed during the pandemic, not you personally, the Fed has been directed to make loans in places where the Fed has not gone before, and maybe they're not 100% guaranteed to pay back. Do you see that as this? I was talking a minute ago about mission creep or mission impossible or something like that. Does that kind of thing worry you?
This is an emergency of a nature that we haven't really seen before. And at the beginning of this, my colleagues and I really saw that we needed to be using our tools to their fullest extent, that it would be very hard to explain to the public why we would hold back from doing that at a time when we saw the 50-year low in unemployment turn into an 80, 90-year high in unemployment in the space of 60 days. We saw the economies around the world shutting down. And I think we felt called to do what we could. And so we crossed a lot of red lines that had not been crossed before. And I'm very comfortable that this is that situation in which you do that and then you figure it out afterward. So that's how I would look at that.
Right. Thank you. In line with that, as you were called to do a lot of things, the Fed has stood up in a very short period of time a veritable alphabet soup of special lending facilities, some of which look like what happened in the financial crisis, but many of which look very different from that. Could you just give us a sense institutionally how hard a task that was? You alluded in my first question that you weren't sleeping much in March, and I can sympathize with that. But could you give us all a sense of how different and how difficult it was for the institution?
Well, I think it is an extraordinary institution. We are lucky to have a large number of highly dedicated, highly capable people, many of whom were here and lived through the global financial crisis and were critical players in implementing the facilities that were put in place then, really to prevent the collapse of the global financial system. Very different set of problems, but so I think we benefit from that experience. And all of us, of course, as you have studied the lessons of the financial crisis a great deal. So I think I think we knew a lot. I think so. I would break it into a series of phases. First, what happened was that as the pandemic, as it became clear, sort of a week or so before the end of February, that the pandemic was going to be a global phenomenon, that any hope that it would be contained in a meaningful way in a province of China was gone. And markets began to struggle with processing that. It's unknowable really, what will be the effect on the global economy? So markets became extremely volatile. Investors fled from any kind of risk, and really markets stopped functioning in a broad sense, so that companies and households couldn't borrow, couldn't roll over debt, and markets kind of closed. So what we did was we came in the first instance, and we tried to restore market function through a variety of ways. We purchased a lot of treasury securities to get that market working again. The short-term money markets, which are systemically important to many private corporations, they stopped working. So we did some facilities there. Then we turned to the provision of credit to corporations and to municipalities and states. That's something we really had not done in modern history at all. But this is not the global financial crisis. That was about weakness in the financial system. This time, the financial system is in good shape, relatively. It's got strong capital, much better risk management, high levels of liquidity. This was a problem in the real economy, in the private sector, of companies not being able to finance themselves. So we announced the setup of a facility to backstop that market. And as we backstop these markets, even before we begin actually lending, they start to work again. There's a confidence factor that we've seen in real force here. So it was a remarkable time. It's a great honor to serve in these jobs. Sometimes they're not easy, but we never forget how important it is, and really what an honor it is to have to be able to be in a job at this time when you're really needed.
Thank you. Let me pursue one particular aspect of that, which I guess is still incipient, or maybe it's just started, you know better than I, which is these so-called Main Street lending programs. I remember when Main Street was first announced, thinking that this was an assignment that pushed the Fed into a place where no Fed had ever been, even more so than the ones that you were just speaking about. Can you comment a bit on the special difficulties the Fed has encountered in standing up this so-called Main Street lending programs?
I'd be glad to. The Main Street facility is for small and medium-sized companies that aren't large enough or in some way don't have the ability to have access to the capital market, so they don't issue public bonds or public equity, meaning that the way they get their financing in their operations is really through the banking system and through non-banks. So we have a facility that deals with companies that have access to the bond market, and Congress has done a lot for smaller companies that are under 500 employees with the Paycheck Protection Program. So this is for the companies that are in the middle, and it is very challenging because it's an extraordinarily diverse space. The credit needs of different kinds of companies in different industries are extraordinarily diverse. Some of them borrow against assets, some against cash flow. Some are much more volatile than others. So it's quite diverse, and trying to figure out the right credit products for that market is challenging. In addition, the world of bank credit is a world in which every credit agreement between a borrower and a bank is negotiated. So each credit agreement is a little bit different. So it doesn't have the degree of standardization, for example, that the bond market has, where there are forms of indentures and forms of prospectuses, and it's much more it's much more routine than it is. So it's challenging to get in there, but nonetheless, get in there we will. And we're days away from making our first loans in Main Street. We have 3 facilities that are part of it. They're meant to reach out to different parts of that broad space. In the meantime, many of those companies are finding that they can borrow from banks. Others are waiting for us to get our facility up and running. It is far and away the biggest challenge of any of the 11 facilities that we've set up are the 3 Main Street facilities. But, the last thing I'll say is, as we've shown, we're very willing to learn from experience. We put out a proposed term sheet. We got a couple thousand letters from people on the first Main Street term sheet. We turned that around. We've consulted actively with all different kinds of companies and experts, and we've now released the documents and do expect to start making loans on Main Street in a few days.
In a few days. Well, congratulations. You envisioning these loans to be $1 million, $500,000? I mean, that was me speaking. You speak. What size loans are we talking about?
So the current structure is that the smallest loans would be about $500,000, and the largest ones could be, over 100, and that's for the larger companies. We're working with companies that have as many as 15,000 employees and $5 billion in revenue, and there's no limit on the bottom end. So I can imagine us expanding on either end too. I mean, the whole nature of this exercise that Congress has given us is go find companies that have employees. Really, it's all about creating a context in which a climate in which employees will have the best chance to either keep their job or go back to their old job or ultimately find a new job. That is the point of this exercise, it's all about those 25 million people or so who've been laid off, the ones who may not be laid off, but may ultimately be laid off. So that's what this is about. And so we're looking for companies in any part of the economy that have employees that are not able to get credit, that would have been able to get credit in 2019. So we're looking back at companies that were in good, solid financial shape before the pandemic. We're trying to find those companies, and we're trying to create credit products that work for them. That's the nature of the exercise.
Tough job. Thank you. Let me finish up before and opening up to questions with one or maybe two more nitty-gritty monetary policy questions. You've had all of these before. Quite a few European central banks and Japan pushed their overnight interest rates into negative territory quite a while ago, in some cases years ago, and have kept them there. Yet the Fed, even before you were chair, has made it quite clear that it doesn't have any intention of doing that. Can you explain why? Is this some aspect of American exceptionalism that's not so obvious? Just generally why?
Maybe I'll give a little context. So the problem of we set a policy rate, which is the federal funds rate, and we lower it, of course, when the economy is weak. We raise it when the economy is stronger. Inflation was more often a problem, and we would often raise it. It hasn't been a problem in a while, but we'd raise it then to sort of prevent the economy from overheating. Hasn't been a problem recently. So in the mid and late 90s, I guess just after you were at the Fed, Alan, Japan hit the effective lower bound, hit zero. And the question came to the fore, what do you do now? And so since really then, it's more than 20 years now, central bankers and economists have been working on the problem of what can central banks do when they hit zero? Are they out of ammunition? The answer is no. So during the global financial crisis, the Fed got to zero. And we did two things. One, we effectively promised to hold our policy interest rate at zero for a long period of time. That affects short, medium, and long-term interest rates, and that supports economic activity because borrowers borrow all across the curve. We also bought, this was what became known as quantitative easing, longer-term Treasury securities and other fully guaranteed securities guaranteed by the U.S. government in order to lower long-term yields. Those are the two principal tools that we used during the financial crisis. We feel that we understand them. We no longer think of them as non-standard tools. We think of them as in the toolbox because we are in an era of much lower interest rates. We do expect part of the time to be at the effective lower bound of zero, which we are in fact now. So some banks decided, in addition to that, to use negative rates. We don't think that that's an appropriate tool here in the United States. I would say the evidence on whether it actually works is mixed. There are clearly some negative side effects, as there sometimes are with these things, and it's just not clear to my colleagues and to me on the Federal Open Market Committee that this is a tool that would be appropriate to deploy here in the United States.
if I can push you on that for just like one more, because what's different in the United States compared to, I don't know, pick it, the Eurozone?
Well, a couple of things. One, first, I don't see that I don't see that the evidence. This isn't really a difference. This is a difference in understanding, and there are many central bankers around the world who feel this way. The evidence on whether it actually helps is pretty ambiguous, because one thing it does is it interferes with the process of credit intermediation that banks undergo. They take in deposits, they lend it out. To the extent the policy rate is negative, you're crushing down on bank margins, and that makes them lend less. And there are other possible negative effects there. I think the evidence is mixed. It's not clear either way. We have institutional arrangements here that would not work with negative rates. I wouldn't say those are decisive. Things like the money market fund industry, which a lot of companies of various kinds use to fund themselves, and which individuals look upon as a place to put their money.
Thank you very much. Let me turn to some questions that have come in from people listening. I'll have to pardon my squinting a little. I'm reading this off my screen with I won't even mention my age. It's older than yours. Eyes. Here's a question that starts with from Frank Brosens, thanking you for your extraordinary job. And the question is, how sensitive is the Fed to the very difficult time that in particular the lower end of the economic spectrum is experiencing these days compared to the extraordinary strength in the equity market that Wall Street has seen? Does that affect policy at all, or is it just a necessary side effect that even if you aren't rooting for it, just happens?
Let me say hello to Frank and say that we know that I guess everyone is affected by the pandemic in a negative way to one degree or another, but the burdens are falling very strongly on those who can least afford to bear them. The unemployed come very largely from parts of the service economy, which involve dealing with large groups of people that are tightly together. So that's restaurants, it's bars, it's travel, it's hotels, it's a lot of places. And many of the jobs that have been lost, at least temporarily, are relatively low paid service industry jobs. So you can just see that those are the people that are being laid off who have the least the least financial resources. For example, in our SHED survey, survey of household economic decision making, which we released a week or so ago, it looks like if you were someone who made $40,000 or less annually, the chances of your being laid off in the last month or so approach 40%. So almost 40% of those people have lost a job. If you're making 40,000, that's so this is falling. Secondly, falling on women to an extraordinary degree. This is falling on women to some extent are in those jobs. And so there's tremendous inequality in the way the pandemic is affecting our population. Now, you ask, does that affect our policy? Look, it does affect our policy. Although essentially part of our mandate is maximum employment. It's maximum employment and stable prices are our monetary policy mandate. So, we're very focused on the full range of employment and doing it whatever we can to really, as I mentioned earlier, to try to get those people back to work or in a new job. Some of those jobs may take a while to come back. It's important that those people be protected from this event. This is not something that was anybody's fault, really. This was a natural disaster. So it's important that they receive support, and they have received a very high degree of support so far.
Thank you. This next question comes, I think, from variants from several people, but in particular came first from Gilchrist Berg. And the question is, what if there's another big wave of COVID-19 in the late fall and the Fed is asked to react again? How big a balance sheet can you manage before it gets to be a problem? And one of the problems he asked in the question is inflation, or maybe you see other problems. But just in general, is there any limit to how big you can make the balance sheet?
So let me start by saying that we're not experts on epidemiology, the spread of pandemics or anything like that. We talk to experts, and the main answer they give you is that things are highly uncertain. So we don't know anything that the general public doesn't know if you're listening to the experts about how this will go. So there is clearly a risk of that, or a risk of a second outbreak or a second wave, and that would be challenging. We of course would continue to react. We're not close to any limits that we might have. I would say we would continue to have some authority to react, but I would worry almost more that a second outbreak would undermine confidence. I mean, a full return to a full recovery of the economy will really depend on people being confident that it's safe to go out and safe to engage in a broad range of economic activities. That's how the economy will recover. And you see people testing the limits now, probably every day. All of us are doing things we might not have done 2 months ago. And you're just seeing how that works. We're watching the data nationally. So that's what's going on. I think a second wave would really undermine public confidence and might make for a longer, a significantly longer recovery and weaker recovery. In terms of the balance sheet, and inflation is the inflation concerns for now are to the downside. The risks are to the downside, not to the upside. We see prices moving down. That's because in a lot of parts of the economy, people are cutting prices. So you'll see weak inflation data for a while. We've been dealing with disinflationary forces for a long time, actually, globally. We've seen inflation. One thing that's happened since 1975 is inflation was really the big economic issue, really since another Princetonian, Paul Volcker, one of the great public servants of our lives, what he did at the Fed and his colleagues did, inflation has really been under control. So it's not the upside risk to inflation is not great. I would say, of course, our balance sheet can't go to infinity. I would say that I'm comfortable with where we are now and the path that we're on, and don't see risks based on what we're doing right now to inflation or to financial stability.
Thank you. We have a couple of variants on this question. I'll read the one that came from Roseanne Harford. It reads, once the Fed is done purchasing fixed income securities, so it's anticipating going down the road you were talking about a little further, what's the plan for managing the portfolio? I read the question as saying it'll have more than fixed income, or it might have more than fixed income securities in it.
Well, we tend to, with the things that wound up on our balance sheet during the financial crisis, we held them to maturity. These are relatively short-term loans of 4 years. So far, that's what we've been doing. So the plan would be not to sell them, but to hold them to maturity. I would say we do not desire to have an active role in managing the portfolio. We're not the right ones to. Once the facilities have done the lending that they're going to do, then the decisions about what to do about covenant defaults and things like that will not be something that we will want to be involved in on a day-to-day basis. And those are arrangements that will work out. We of course have a financial advisor on each of these facilities, and in some way or other that will be managed in a commercially reasonable way, but not by Fed policymakers.
Okay, thank you. That's very useful. There's a generic question from Judy Jang about how would the Fed go about communicating with the public on these emergency tools, and in particular in an effort to avoid some of the misunderstandings that took root after the emergency measures of the financial crisis about a decade ago. That proved, as you well know, not to be too popular with the public, even though it was tremendously successful.
Well, the first thing is that we're disclosing just a lot of information, much more than the law actually requires us to disclose. We're disclosing for all of the facilities under the CARES Act. We'll be disclosing the name of the borrower, the amount, and we'll be updating those on a very regular basis. So I like to think that, disclosure will really help, because I read things in the paper that are supposedly happening, and I know they're not happening. For one reason they're not happening is we actually haven't made very many loans yet. So I read that we're extending tons of credit to this industry or that. Actually, we haven't really made a lot of loans in the corporate credit facilities. We haven't started the municipal facility yet. So I think so transparency is really important. I also think we have to this is something we've been focused on. Alan, you were at the very beginning of the transparency revolution and one of its principal authors. So I think the old theory was tell them nothing. There should be a lot of mystery around central banking. Alan and a bunch of other researchers really flipped that completely around, and now the view has been for some time that transparency is your friend, that markets will do the work for you if they understand what you're doing. So we work very hard to explain ourselves to the general public, and particularly focused on the general public's elected representatives in Congress. We work really hard to stay in communication with them, the ones who are on the committee, the ones in leadership, the ones who are not on the committee, just so. And also we try to communicate publicly through a lot of outreach so that we explain what we really are doing and try to avoid misunderstanding. And also, by the way, listen to feedback. We listen. We did this round of events over the last year or so called Fed Listens, which was really such a successful program where we listen to people from all different walks of American life talk about how they think about the Fed and monetary policy. And I would tell you, it really informed the work we've been doing in sort of reviewing the way we do what we do.
Just as a footnote to that, I'm happy every time you draw the distinction between lending and spending. But a warning, I wrote a whole book on the crisis, as you know. The public left that with no distinction, thinking that the Federal Reserve had spent all this money and the Treasury had spent all this money, even though virtually every penny of it was lending, not spending. So this is something that don't think I have a magic solution to how you explain this to the average American, but it's a huge task. And in the case of the financial crisis, they never really got the distinction. So good luck with that.
Alan, I would just say most people have better things to do in their life than to understand the details of central banking. And I think working at the Fed, you get that from day one. But our obligation is to be as transparent as possible and to patiently and clearly explain ourselves to the public that we serve. And we just work really hard at that. And that's part of the job. It's part of how we retain our democratic legitimacy.
Thank you. We've got time for a few more questions. I'm squinting at the screen to try to read them. Michelle Lou Petkoff asks, are the latest Fed, this is a bit related to a previous question, are the latest Fed policies likely to lead to more income inequality in the United States?
Absolutely not. And I'll tell you why. As I mentioned, the pandemic is falling on those least able to bear its burdens. It is a great increaser of inequality. If you just look at the labor market reports that the Bureau of Labor Statistics puts out, you will see that it is low-paid workers in the service industries who are bearing the brunt of this. It's also women to an extraordinary degree, as I mentioned. So everything we do is focused on creating an environment in which those people will have their best chance to keep their job or get a new job, maybe go back to their old job if they've been furloughed. Now, how does that work? So take a company that, for example, I won't give a name, but just as an example, a company that was investment grade on March 22nd, but that's now been downgraded to so-called junk, a non-investment grade company, but that has tens and tens of thousands of employees. Now, why would we include that company in one of our programs? These are very large companies, and there are many of them that would fit that description. I'm not thinking of any one. Well, the reason is this. If a company like that doesn't have market access and can't roll over its debt and can't have enough cash on hand to deal with its obligations, what they're going to do is they're going to lay people off. They're going to cut costs. They won't have any choice. That is the choice they will make. Let's put it that way. So by announcing our facility and including those companies, the ones who actually need the credit or needed the credit in March, those companies have now been able to go out and finance themselves and have now lots of cash on their balance sheets. And for the most part, haven't. These are companies that are not so directly affected as some of those service industry companies are that deal directly with with the public in large numbers. They've been able to avoid big layoffs. So it really is, that is the point of all this. And I think we have to keep our focus really tightly on that goal of the labor market and supporting the labor market and not get distracted by other goals.
Thank you. I think this will be the last question, and it takes us outside the boundaries of the United States. Catherine Rampell asks, as the Fed looks at the global economic situation, what are you thinking about the what's happening both in the pandemic and in the economics in some of the poorer countries in Asia, and she lists India, Pakistan, and Indonesia as examples?
So this is a very challenging time for those countries. They don't have the kind of medical infrastructure that we have. They don't have the policy space, as we say. They don't have the ability to provide support to their economy either through fiscal policy or monetary policy that we do. So it's a very, very difficult, challenging time for many of those poorer countries. And the International Monetary Fund and the World Bank are doing, everything they can to get more resources and try to help those countries. But there's no question, for all of the suffering that's going on in the countries like the United States, Western Europe, you're seeing even worse outcomes in many of the poorer countries. And it's something that that those international organizations are going to need a lot of support from nations like the United States and have been getting it, to deal with.
I have one final question from an extremely important person, very important person. Susan Powell asks, and she starts phrasing it, Chairman Powell, do you have a favorite child? And should that favorite child be congratulated on anything?
I love all my children equally, but I certainly think Susan Powell deserves special congratulations here today for graduating in the class of 2020. So thank you. Thank you, Susan.
And all of us here join that. Congratulations, Susan. The class of 2020 will long remember the end of its senior year, and is going to get two graduations, as probably most people on the call don't know. A virtual one happening soon, and then another physical one in a year's time. So, Chairman Powell, on behalf of the Griswold Center, if I may take the liberty, although I'm not a member, on behalf of the class of 1975, on behalf of the entire Princeton University community, and indeed the citizenry of the United States, I want to thank you for your service. I want to thank you for spending the time with us this morning. We are deeply in your debt, and really glad that you're the chairman of the Federal Reserve. So thank you.
Thank you, Alan. Thanks. Great to be here today.
That's Fed Chair Powell with Alan Blinder, former Fed Vice Chair at Princeton reunions, talking to a somewhat broader audience this time, ferreting out some bits of news, Steve Leisman, from Peterson and from 60 Minutes in the last few weeks, obviously commenting that the Fed did cross some historical lines, but that it was appropriate, talked about a confidence factor, especially with regards to a potential second wave of the virus. Main Street lending begins in a few days. Again, the 1,000th question about negative rates. not working, at least mixed evidence that it works well with serious side effects.
Yeah, I would bullet all of those as the main news from the conversation he just had. I'd add to that the idea that the balance sheet is not close to any limit that he would be comfortable with. He doesn't see it creating financial stability or inflation risk, which means he's comfortable where it is now, where it's going, and also suggested there's more to react. I thought the red line comment was a little curious. Maybe come back to that in just a second. But this second wave concern is a theme that Chairman Powell has really talked about quite a bit. And there it was again, saying a second wave of the virus in the fall could undermine confidence and create a longer recovery. That's obviously the biggest risk I think he sees out there to the economy right now. Days from launching this Main Street facility, Carl, it's been a long time in the making. There were three different buckets, the $600 billion loan where the Fed is going where it has never gone before, along with the corporate loans it's giving. And I'm not sure he meant to use the word red line. I think a red line is something that is essentially illegal to cross. I think he meant a line that they hadn't crossed before, but I'm not sure he meant red line in that context.
Mike Santoli, some modest gains on the S&P during the past 45 minutes, but perhaps not too much to speak of. The Dow didn't seem to respond that much either. Would you put this in the category of the Fed chair restating what he's already said before and perhaps adding to the sense of relative stability that the markets have been feeling?
Yeah, I think, John, that certainly a reminder of the Fed's posture, which is really focused on risk management, the potential downside of an economy that doesn't come back fully or has another relapse down the road. And what does that mean? The takeaway for investors is a pretty strong signaling effect just in that kind of commentary, which says we are in no hurry to pull back on any of these programs, to sort of declare a return to normal. As much as the equity markets have tried to get to a place that tries to handicap some approach to normalcy again, the Fed is still worried about, those massive unemployment and the reuptake of all these jobless workers and what they're going to have to do to make that happen. So I think for the market's point of view, it's kind of cushioning the downside scenario, which again is a reminder of how the Fed has approached this for a few months now.
Yeah, Rick Santelli, I want to bring you into the conversation as well. I mean, when you hear the Fed chair talk about the full recovery depending on people feeling that it's safe to come out and just how detrimental a second wave of the virus could be and really add to a significantly longer, weaker economic recovery. You take that, you couple it with what's been another wave of painful data today, albeit much of that now dated. How is this playing out in the bond market? Is it similar concerns among those investors?
Well, in terms of the data today, much of the data has already turned, and much of the worst data is in the rearview mirror. There's some exceptions to that, Chicago PMI, for example. But for the most part, and with regard to the interest rate markets, as John Ford pointed out, whether you're looking at the Dow or you're looking at 10-year notes or 2-year notes or boons, nothing really plainer. And so why do you need to do that? Because we now truly have a fourth branch of government, or whatever branch you want to talk about in other countries, because central banks around the globe have now become the power. Think about it. Look at what is going on in Europe, the way they've changed the Germans' mind to actually have shared debt. Like the changes, the real changes and the money are coming from central banks. And that isn't going to dissipate soon. And I think Vice Chair Blinder really set the pace when he said, really what this is about is we don't want anybody to get misconceptions this time the way they did in the last crisis. And I think there's a degree of, talking down. I mean, Alan Blinder is definitely saying that they know better than everybody else, and in some ways they do. because you're not going to get Republicans or Democrats individually to be able to ever implement the programs that the Fed has implemented in the time frame that they've done it. Granted, the Treasury's involved, and granted, you don't want to use the word red line. I get that very well. But in the end, they're the only entity that could have pulled it off. And they're not going anywhere, and their power isn't going to diminish. They're here to stay, and there's going to be a lot more of this type of communication because they've gone from kind of underground, under the radar as a preference to the necessity of unelected people, for the most part, with this type of power, have to have more direct communication with the average guy on the street.
Yeah, that clearly, Rick, was the subtext of the entire discussion almost from the beginning when Blinder asked Powell to essentially describe what the Fed is to people who don't spend a lot of time thinking about it. As far as the Main Street lending program goes, it was interesting to hear him talk about that program as a challenge relative to the other emergency measures. Here's what he said.
We're days away from making our first loans in Main Street. We have 3 facilities that are part of it. They're meant to reach out to different parts of that broad space. In the meantime, many of those companies are finding that they can borrow from banks. Others are waiting for us to get our facility up and running. It is far and away the biggest challenge of any of the 11 facilities that we've set up.
All right. So, Steve, given that bit of sound and what Rick just said, we're going to hear from him again, wouldn't you say, in the coming weeks?
Yeah, I did want to comment on Rick's comment, which I think is a really good one, and the one that you said too, Carl, which is, you know, the Fed is involved in a serious PR campaign here, and it begins with the name Main Street Lending Facility. Would it surprise you to learn that the minimum size of a company that qualifies for Main Street lending is 500 employees? Now, everybody close their eyes and imagine a Main Street and tell me which store has 500 or which company has 500 employees in it. And so that whole thing, even just the name, every single term sheet it puts out, the Fed says, we're doing this to enhance the ability of households and businesses to get credit. That's true, but it's not necessarily the whole truth. The Fed is supporting structures that provide credit, not necessarily the actual provision of credit. That is an indirect effect of it. But like asset-backed securities, where people get car loans through those or credit card loans through those. That's what the Fed is supporting. It's supporting the existing financial system. And the Fed is trying not to make the mistake that happened last time, was everything it did, it was blamed for helping Wall Street. And of course, part of the reason for that was because Wall Street was the big problem back then.
Yeah, it's a key point, Mike Santoli. But you also make the point that in this conversation where he does talk about transparency and the importance of it, what that does also mean for the markets and for investors as they look forward to see how the Fed will continue to, I guess, support, buoy, or drive the narrative for the markets.
Yeah, he basically said clarity about the Fed's intentions gets the market to do what the Fed wants to happen. And that, I think, is evident if you look at the corporate bond market. They said they're going to buy corporate bonds, including some high yield. Those markets got very, very liquid very quickly. Investors kind of took their word for it even before the Fed had to buy any or at least much. So that's sort of the cycle that we're on. Now, they do have to follow through and do something, or else maybe next time it's not going to work as well. But that's so far been relatively effective.
Yeah. Steve, Rick, Mike, thank you guys. Everybody have a good weekend. Don't forget tonight, Jim, Mad Money 6 p.m. has Fastly, Elf, and Zscaler. Let's get to the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Good to have you with us on this Friday. Our top story this hour, rally and risk, and whether your money has much room left to run. That debate starting right now with our investment committee. Joining me on this Friday, Josh Brown, Steve Weiss, John Najarian. Margaret Reed is the senior portfolio manager with the private bank at Union Bank. And Kate Moore is back with us today, BlackRock's head of thematic strategy for the Global Allocation Investment Team. Take a look where we are in the markets right now. We are red in most places. However, interesting to note today that the NASDAQ is the index that is higher today. There's been that move into value of late, but today money's coming back in as stocks are on pace for their second positive month in a row. The Dow is on track for its best week since early April. Josh Brown, you can take stock in this for me. So we've been talking about a rotation. Yeah. We've talked about growth into value. Well, on a day where you've got red in a lot of places, I've got Apple, I've got Amazon, I got Microsoft, I got Facebook, and I've got Netflix, and I got all of them higher today. Can we end the talk about a rotation out of those names?
Well, I don't know if it's the end, but this is what has continued to happen. So if you actually look, 29 S&P 500 stocks that are up 20% on the year or more, 25 of those are up today. So it's back to the winners. 30-25 on the S&P, Judge, broadly speaking, looks like a logical place to see a pause. That was, if you remember, resistance back in both July and September of 2019. The market struggled there to find buyers. Eventually, we got through it, but that makes sense for that old resistance to now become support. And the technicians that I talk to, when they're looking at breadth and they're looking at internals, one of them pointed out that we now have a situation where 96% of the S&P 500 are above their 50-day. That is the most overbought on that metric that we've seen since back in the early 2000s. So you've just had this huge run in all kinds of stocks, and it was great to see. But as we've pointed out on the show, those episodes have been short-lived. So I'm not shocked at all to see big tech green and a lot of red elsewhere.
Yeah. Kate Moore, I'm wondering now, so you've got this heightened geopolitical risk. Haven't had that in a while to the level we do today. President's going to give a news conference at some point today. You've got what many perceive to be a stretched market. You put 1 + 1, do you equal swoon in June, or where do we go?
You know, I got to agree with Josh. I think we're at or close to the top of what feels like a rational, whether it's from the technicals or from the fundamentals. And I think this point around China cannot be underscored enough. You know, we are in a much more heightened and much more sort of threatening geopolitical environment than several months ago. We have no expectation for that to dissipate through the balance of 2020. I believe China is going to be the core of the debate going into the election between Trump and each side trying to show that they're tougher on a perceived enemy than the next. And so against that backdrop, where so many of our big bellwether companies, our multinationals, a lot of the tech folks are reliant on revenue streams or businesses or supply chains in China and the rest of Asia, I think we're going to see a fair amount of pressure.
So, John Najarian, let me build off what Kate Moore is saying here, because it's important, and frankly, it's dominating the narrative on the street today. J.P. Morgan's Marco Kolanovich, okay, guy considered, one of those who can move the market. He talks about the dialing down the market optimism today and says a complete breakdown of supply chains and international trade, primarily between the two largest economies, the U.S. and China, would justify equities trading drastically lower. Tony Dwyer, door is open for potential consolidation. Escalating tension with China, he mentions. There's Lori Calvasina of RBC today mentioning the rally as being fragile. China is front and center in the top part of her note as well. How concerned should we be now?
Well, Scott, I think both Kate and Josh touched on the points that I'd make as well, and that is that the reason that we're seeing all of those stocks that you mentioned, the Fang Man or whatever, the reason we're seeing that group higher is whenever we see uncertainty in the market, rather than just a straight out bear market whoosh lower, if we just have uncertainty, people go to stocks with certainty. So they're very confident of Microsoft, of Apple, of Netflix, of Amazon. They're confident with those names, Scott. So on days like today, where the president may or may not go really hardcore against China and what's going on in Hong Kong, will most probably touch on what's going on in Minneapolis and so forth. On days like that, you're going to see people basically looking for a little bit of a safe harbor. And when they look around and they see those names, and many of which are lifting, as you noted, Zscaler, a whole bunch of other stocks that are outside of the Fang Man, they want to put the money into that area, Scott. And thus, by not having supportive hands in the others, some of these other stocks are drifting lower. They're not being slammed lower. And I don't know that the rotation is at all over. It'll all depend on exactly how much of a fight this is going to be based on what the president says this evening, if it is indeed this evening, this afternoon or evening, about China.
Yeah. Margaret Reed, does the rally feel fragile to you today, or does it feel like it's on firm footing?
Scott. I would certainly argue that the rally is more of a on a period of consolidation. You know, we've seen this market narrative this week around rotation from growth to value. We've seen these gyrations of rotation before, particularly when the markets are sitting in a recovery mode. So, you know, certainly the policy risks that were not being discounted so much in the beginning of the month of May, now these are coming front and center for investors. Could this be, you know, a reason for some consolidation in the marketplace? Absolutely. But that doesn't mean that there shouldn't be still opportunities within various sectors because there is such a dichotomy right now between where the markets are at, where some of these more defensive or cyclical or tech sectors are in their recovery, comparing that against what's actually happening in the underlying economy and the underlying fundamentals of these companies.
Yeah, Steve Weiss, it's interesting. Margaret uses the word consolidation, which is a popular word today across the street. It's in Tony Dwyer's note. But look, some people are looking, if not hoping, for some sort of consolidation to get another more attractive entry point. That's what he's looking at. Because in many cases, whether it is the value trade, which over the last 2 days before today, you had seen some of these stocks just go up by astronomical amounts in just a couple of days, or the high growth tech trade, which had seen those stocks go up by astronomical amounts, but simply over a longer period of time, is as stretched as the value trade may be just over a different time period.
So the way I look at it is that the market should consolidate after any move of reasonable strength, as we've seen here. It's healthy to have a consolidation. The upper end of the trading range I've been looking for right about here, actually a little lower. But I think there's a misperception out there. And the misperception, in my view, is that you have value in these stocks that have underperformed, the ones you referenced, that had the big moves over the last 2 days. Just because stock prices are lower doesn't mean the values increase. In fact, these business models are impinged now more so than they were before, so you're going back to growth.
But why did those stocks, though, but Steve, why did those stocks go up the way they did over the period in which they did? We're talking airlines, we're talking cruise lines, some of the casinos, some of the industrial names, the more cyclical places, some materials. You get the picture here.
I do, and I believe they rose because you've got so much news on vaccines, so many competing vaccines coming into the market that people were looking for a quicker end. And there's also a lot of momentum at play in the market, and those stocks started to move. People didn't want to miss them, so they got in. Now you're sitting back and you're saying, wait a second, I've got some risks here, and I've been pointing out China as a risk. But I don't think it's the big risk out there because the market's got a memory. And we went through this before in spades last year as tariffs first came on, and we got out of it. So, but those stocks, if the tariffs come back, the value stocks, so-called value stocks, be the ones impacted. I also think what we're seeing here, in addition to the return from growth, we're ignoring some of the risks to the technology stocks. But here's how I see it playing out from a sensible standpoint, is that there's not a lot that Trump wants to do to further put the economy back on its heels. Now, if you go out and you take the legs out from under the tech stocks, then you're going to really crush the market. He doesn't want to do that. So he'll talk tough, but I don't believe anything's going to happen.
He may feel like, though, he has some capital in the fact that the market has bounced back in the way it has. And, frankly, the reopening stories around this country thus far aren't nearly as bad as the worst of the fears were when some of these states were reopening. He may feel like that is a little bit of capital for him to now use it to push on China a little bit more than some people are expecting. Maybe that's a hidden risk that we have to take into consideration. I also want to bring in the fact of where the market is technically, and for that we bring in Jonathan Krinsky. He is back with us today. He is a good voice on that. He's the chief market technician at Baycrest Partners. Jonathan, it's good to have you back.
Thanks, Scott. Always good to be here.
Yeah, so you've heard the conversation, I hope. How are you feeling about how far we've come, where we may go from here, and why?
Yeah, so thanks. I think last time we were on your show was May 18th, and we're making a call for a momentum reversal. You know, there's a lot of talk about value versus growth, but really the reality is the market's trading on high momentum stocks and low momentum stocks. So we had a reversal of that by a pretty meaningful magnitude. So a lot of the banks and retail, cruise lines, all the stuff you've been talking about had very significant rallies off the lows. That's typically what you see towards the later innings of a rally. And I think now we're getting to a point where we had growth lead us off the lows in March, and then we had value play catch-up, or low momentum play catch-up. And now we're at a point where I think things are getting a bit difficult here. And one of the major reasons that leads us to this conclusion is sentiment. And if we look at something like a 10-day moving average of the put-call ratios, we're now down below 0.6 on that ratio. And when you had that combined with a rally of this magnitude in the S&P, we've only had that 15 times in the last 25 years. And the average 2-week return following that occurrence is about negative 1%. We're only up about a third of the time. So I think the setup here is a move back down. It doesn't have to be massive, but I think some of those value stocks that let us off the lows are probably going to lead us back lower. And then we'll see if we finally see a pullback in some of the more high momentum growth names that have been so resilient of late.
You raise an interesting point, on one that we've sort of kicked around a few moments ago, of what's left to move you higher. Right, you had a massive move in tech growth. You had a massive, very short-term move in beaten down value. What are you going to hang your hat on now?
That's the call here, and I think if you are looking for a place to go, you can probably go back into some of the real defensives, the utilities and the staples that have kind of been more yield plays. But as far as the mega cap tech growth names, they're still in good structural positions. But to your point, I think a lot of money has moved into those names for their perceived safety. So again, we don't really see the next upside catalyst in the very near term.
Unless I counter that by saying, look, the unprecedented liquidity from the Fed is so overwhelmingly powerful. Don't discount that, which I know you're not, and nobody else is. I mean, it's the reason primarily we are where we are. However, if the reopening story, Jonathan, continues to be positive, and we certainly hope it does, it's going to be hard-pressed to figure a reason why you would want to push stocks lower if you can actually add some fundamental turnaround in the economy, even incremental, and albeit small. If you can add that to a liquidity equation, you can come out with a sum that's pretty good on the other side of that.
Yeah, I think that's fair. But again, when markets get extended, they can correct in two ways, through time or through price. So, I think the bullish scenario would just be a sideways consolidation, like some of your prior guests were talking about. I think the risk, though, is that, people got a little too complacent, again, given those put-call ratios, some of the other sentiment measures we can look at. And, we're already seeing some of those retail names that we highlighted last week. They rallied 40 to 50%, and now they're giving back 20 to 30% of the rally. So you just have to be a bit careful and know your time frame. But we do think the risk reward as we head into June, and we'll add one other point. June is the second worst month for the S&P going back 30 years. Now, last year, June was up very big, but that's because May was down very big. We have the opposite set up this month in that we're coming off a very strong May. So we just think you add all these things up, seasonality, sentiment, positioning, and the odds are for a bit of a pullback.
Yeah, I hear you, but I also would say, okay, you come into May every year and hear that, sell in May, go away stuff, and obviously we didn't get that. So history only takes you so far down the road. John Najarian, the floor is yours.
Jonathan, thank you, Scott. Quick couple points, really. Obviously, Williams-Sonoma, blowout earnings and through the 52-week high, Jonathan. And we both know some of the reason for that retailer to blow up like that is because people were buying more stuff for their homes while we were all hunkered down. But how about that 33%, the amount of savings that U.S. consumers, since we had that data this morning, that money, along with the reopening, and to Scott's point, the very low interest rates, the stimulative boost that we've got going on, you get these states reopening here, Jonathan, I think you're going to start seeing a lot more. It's not just the omni-channel, not just the online stuff, when people can actually go out into these stores, as they're starting to do in states like Florida, Georgia, Indiana, and the like. What do you think of that as that driver to lift you significantly higher than where we are right now?
Yeah, John, that's a good point. Williams-Sonoma was a strong stock heading into those numbers, so it's a little different setup than some of the traditional heavily shorted retailers that were kind of sitting out near 52-week lows. But there are going to be certain story stocks that kind of buck the trend. I think our point here is that on a broad-based market call, the risk is just not risk reward is not great. But certainly you're going to find your certain stocks, and that's where you got to do your homework.
Jonathan Krinsky, appreciate it. You be well. Have a good weekend. We'll see you on the other side, I'm sure.
Thanks, you too.
All right, take care. So, Kate Moore, you've got a few things that may be working against you if there's a rotation out of some of the higher flyers. You got maybe technicals against you. But what do you think? What do you think about what you heard from Jonathan Krinsky here?
Yeah, look, I think he made some good points, around momentum and seeing this little bit of a reversal. And certainly in the last 5 days, we've had this rip-roaring move from like small cap, mid cap, lower quality, weaker balance sheets. But we don't really think that's going to be sustainable. I do think that some of the, let's call them crowded, high-flying tech names deserve to be crowded, frankly. These are companies that are putting up the numbers, and I just don't think you're going to get a sustained rotation into some of the more value-oriented, weaker quality balance sheet, and, frankly, more structurally impaired industries. You're just not going to get that unless we are talking about a return to an economic environment that looks more like it did in January or February. We don't expect that to happen for the foreseeable future. And Scott, you made this point a moment ago. Some of the reopening stories are not as bad as some people had feared, right? We haven't seen as big of an uptick in terms of cases. Activity is coming back. But I will go back to the China model, and I think this is super important. We look at China, which has largely reopened its economy. The supply side has rebounded, but there are pockets of demand that are remaining relatively weak, particularly around consumption. You might get some high-end consumption and you get some low-end, more kind of staples or consistent consumption, but the discretionary spend hasn't really rebounded yet. And that's going to be the key thing to watch. Stay in the high-quality companies that can generate revenue growth, but watch very closely getting too much into the names that may take a lot longer to recover from the demand side.
I'll tell you what, Josh, you don't have, some of the more bullish people on Wall Street backing off their targets, right? We've had I think we had Tom Lee on at the beginning of this week. Maybe it was the end of last week at this point. They kind of all blend together, and I know everybody knows what I mean. 3,400, right? Tom Lee, you could hit this year, new highs. Barry Bannister, 3,200. David Kostin has not been the most bullish person throughout this whole thing, Josh, and at Goldman, and he's sticking with 3,000. By the end of the year, you may get some, push and pull here and there. And there's Brian Belsky, who's like, look, I understand that PE multiples have, expanded recently because of the moves that we've seen in the market. But he says, don't fret it. Given the backdrop of low interest rates and inflation, he says that the S&P PE may actually not be as overvalued as some investors may think.
One of the smartest people I talk to, he's anonymous on social media at Econompic, but he posed the question: would the market be higher or lower than where it is now, absent the coronavirus situation? I forget if it was a poll or just people responding, but the consensus was actually the stock market might be higher than it would have been if we were just in an ordinary period of time. So, Scott, the points that you're making are the right ones. I know everyone hates the argument about cash on the sidelines, but it's undeniable that there's over $4 trillion sitting in money markets, cash. And to some extent, when you look at the news and how many brokerage accounts are being opened and how many small investors are getting in and how many large investors are underinvested given how well the market's done, you can make that case logically that Tom's target will be proven correct. I think one thing we haven't touched on, I'd love to hear Kate Moore's take on this. We're at a decision point come July about whether or not to extend the $600 per person extra unemployment benefits. It's been estimated that 2/3 of workers are making more right now not working than they were in their real job because of that extended benefit. That runs out. And I know a lot of the retail stocks we've been talking about, Walmart, Target, have benefited as a result of consumers having more money than they were accustomed to having, even though they were furloughed or unemployed. So I don't know what Congress is going to do. That's going to have an impact on some of the biggest most important to the index stocks that we've been talking about all this time, do we extend it or not? Or do they do a return to work credit of $450, which is something the Republicans are thinking about? So I think that's on the horizon for all of these tech and consumer plays. I don't know how it'll fall, but that's going to be a moment for the market.
Kate Moore, do you want to answer that?
Yeah, look, I think that's a great point you're making, Josh. I mean, to date, the stimulus that we've gotten has been really about income replacement and really sort of plugging the hole, in some cases actually plugging the hole and then some, relative to the incomes that some of these workers were receiving before the crisis. But I think this is a great question around July. You know, are we going to get another round of stimulus that continues to support income, or is the stimulus going to rotate a little bit and be more about supporting, you know, businesses instead of individuals? I think this policy and this debate over the next 30 to 45 days is going to be critical. And, you know, especially as we start thinking longer term, second half of 2020, first half of 2021, in terms of the earnings for a lot of these consumer companies. You know, our expectation at this point is that you're going to have some air pockets, that it's not going to be a smooth ride, and that it's going to become difficult for the government to consistently provide overall income support on an ongoing and indefinite basis. So they're going to have to focus on other policies. And a lot's going to, frankly, get dictated by the election and the debate around growth going into it.
Margaret Reed, you know, the best way to really truly find out where members of my investment committee stand is how they're voting with their wallets, so to speak, or their portfolios. And by that, I mean, I want to know what you're buying, if anything, because that is a good tell, and where, as to how you truly feel about where we may be going from here. What can you tell us?
Sure. I absolutely echo a lot of the points, particularly what Kate said around, you know, the focus on quality, the focus on companies that are generating revenue and earnings, or that have some fundamental underpinnings as to why they can recover in that revenue and earnings trajectory. So I had shared, you know, some of our adjustments early on this year, which was really, you know, focused in on the companies with the balance sheets that are unlikely to have, you know, some real particular impairment or damage up to come. So, you know, we've been reducing areas that are highly levered, reducing areas that, you know, or on the flip side, might have gotten the market a little bit ahead of itself. And then in the pullback of the market, again, taking opportunity that was presented in the lows of March, adding to certain names in healthcare, certain names in the discretionary side that we see as part of the recovery, the eventual recovery. Or, you know, if we, you know, on the focus around rotation, I think it's really critical too to not just focus on rotation within the market, because that's obviously what we focus on every day, but also the rotation that's happening in the economy and what will structurally be changed from this day forth, given COVID, given the work from home environment, and even with the economy reopening. There is going to be a substantial amount of behavior change that is still yet to be seen. And that's something that, you know, we're really focused in on, is ensuring that we're adjusted in terms of where we're invested, what exposures we have to, because there's so much structural change ahead, in addition to what is likely to be structurally high unemployment. And that will shift where consumers spend, and likely away from areas like leisure and lodging, away from traditional apparel, and more of these needs-based, you know, consumers looking for value and convenience, which sets up, you know, very beneficially names like an Amazon, like a Costco or Target, that are already delivering this for consumers.
John Najarian, what are you doing in the market? You're pretty nimble. You got a lot of stuff going on pretty much every day. What about now?
Well, Scott, there's a couple stocks. I'll have one of which on unusual activity that have announcements coming our way. I've been sort of focused in on these in the short term. I've, as we noted last week, took some pain in those Chinese stocks, exited those. I'm in the FXI puts right now, Scott, anticipating a little more pressure to the downside after the president makes his announcement, whatever that might be, tonight. I think either way, it's not going to be positive for those stocks.
So, Josh, you know, there was a point where you had been invested in KWeb, right? The Chinese internet ETF. Would you advise people to get in, or to get into that, or just, if you are in it now, to get out because of what we started our program with today, these tensions with China?
Well, if you look back at the last round of tensions with China, these stocks didn't necessarily perform in any specific way. They might have moved daily on headlines, but I don't think it hurt the underlying companies at all. Most of the companies we're talking about do not do business in the United States. If you look at the makeup of an ETF like that, those are mainland China operating businesses. So they're not. It's not as though Alibaba is selling product in North Dakota. So I don't really see that to be an issue for those stocks. I understand from a sentiment perspective, it might make an institutional investor say, we have too much China, let's not add.
Right.
So maybe at the margin. But I think those stocks need to be looked at as a world unto themselves.
Quick break, come back. We got Call of the Day, we got Unusual, we have Ask Halftime. We'll see you in 2 minutes.
With millions of podcasts dropping new episodes all the time, how do you keep up with all your favorites? TuneIn makes it easy. Simply head to the home screen and find your new episodes section to see the latest additions.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
Brian Windhorst and the Hoop Collective Podcast.
What about Giannis Antetokounmpo? He is going to be eligible to sign a Supermax extension, which we were projecting to be worth $240 million this summer. Well, if the salary cap drops, and even if he's wonderfully happy in Milwaukee, it may make no sense for him to sign when he can just wait a year and wait for the revenues to recover and then lock in.
Subscribe to Brian Windhorst and the Hoop Collective.
Search the Hoop Collective to listen. It's TuneIn Sports on this day. On this day in 1980, Larry Bird beats out Magic Johnson for NBA Rookie of the Year.
Larry Bird and Captain Black, Irvin Magic Johnson.
You know, I see all these highlights. Haven't seen a lot of them for a long time, but, you know, I played for the Boston Celtics, if you didn't know that. I'm very proud, too.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
Wanna bet football can make you feel nostalgic?
Playing days are over, so...
On the podcast, NFL Alumni Lounge, Charlie Booth sits down with retired NFL legends to talk about their careers, life after football, and everything in between.
Mr. Darren Waller, good to have you.
Yes, sir, it's good to be here.
Dana White, welcome to the Alumni Lounge.
Thanks for having me, brother.
Big member of our NFL alumni family, the CEO of the XFL, Mr. Oliver Luck.
Charlie, good to see you. Thanks for having me.
We're here with the president, Mr. Eric Price. Good to see you.
Search NFL Alumni Lounge on TuneIn to listen.
Car insurance.
All right, we welcome you back. You saw their stocks were lower on these escalating tensions today with China, and now we do have a time for that presidential news conference. It's going to be at 2 o'clock today, 2 p.m. Eastern time in the Rose Garden. We will see President Trump and find out exactly what he is going to do this afternoon. Sue Herrera, we've been waiting for a time. We finally have it. Stocks haven't been waiting around, though. They've been selling off in anticipation of what may happen later this afternoon.
Absolutely, and we saw that right before the close yesterday, too, Scott. And we will be monitoring that news conference with the president in the Rose Garden. We are also monitoring the promising chair for the officers involved in the death of George Floyd. And while he understands, quote, generations of pain are manifesting themselves in front of the world, end quote, he believes order must be restored before addressing long-term racial issues.
I'm asking you to help us. Help us use humane way to get the streets to a place where we can restore the justice so that those that are expressing rage and anger and demanding justice are heard.
Democratic presidential candidate Joe Biden is criticizing the arrest of a CNN reporter and crew on live TV while they were covering the protests in Minneapolis, tweeting, quote, "This is not abstract. A black reporter was arrested while doing his job, while the white police officer who killed George Floyd remains free," end quote. Governor Walz has apologized for the arrest, saying there's no reason it should have happened. And Scott, we're going to have an update for you on the developing situation in Minneapolis every hour today.
All right.
Back to you.
Yeah, we'll look forward to that. Sue, thank you very much. Sue Herrera. Let's go to Dom Chu now. He has some breaking news regarding Morgan Stanley. Dom?
Considered maybe green shoots if you're looking for some more signs of a return to normalcy, normality, whatever your term is. Take a look at what's happening with Morgan Stanley, because CNBC has learned via sources familiar that Morgan Stanley will look to target bringing some of its staff back, its trading staff back, to its headquarters office in New York City sometime in mid to late June. Now, this follows on Goldman Sachs with its own plans, reportedly to bring back some of its trading staff in the coming weeks and months as well. For Morgan Stanley, though, those sources tell CNBC a welcome kit for those employees will include things like hand sanitizers, masks, and other protective equipment. They will be required to wear those masks in public places around the office, although not at their desks. So another sign of Wall Street trying to get back to work. Scott, back over to you guys.
Some semblance
and,
of...
by the way, I should also point out that full story is right now on CNBC.com. A great story if you're looking for any signs that Wall Street is returning to normalcy. Scott, back over to you.
Yeah, it's going to be interesting, Dom. I appreciate that. Thank you very much, to see what that office at Morgan Stanley actually looks like when those traders return there. We'll continue to follow that story, of course. Let's talk now about Lululemon. Holding up today, despite the market, shares hit a new all-time high, in fact, as Raymond James raises its price target on the stock to a street high $335. Says the apparel retailer is a top long-term idea, which if you listen to Steve Weiss many months ago, he would have told you the same thing, though he's traded in and out of it, I think. So what's the story today, Weiss?
Well, the story is that I'm long it. After I sold it, I realized I made a... Well, the story is that I'm long it. After I sold it, I realized I made a big mistake, and I went back in. So it's actually a fairly sizable position. And here's why. I wear Lululemon. I went on the site, tried to buy some things, and I always check, of course, what their category we made too much of the sale items. Nothing's available, and there are no more sale items than there typically were. Additionally, when the company last spoke to us, same-store sales were up 20%. So their wear has become the new office wear for home. So anybody I talk to, as you do an informal survey, is buying more, replenishing. So they've got a moat around their business. They always did. There's no competition in the upper end. If you want to go to retail, you want to favor the upper end consumer, who's not going to be hurt, unfortunately, by what we're seeing. So I think it plays perfectly. Their website's great, and the company's doing extremely well. So I also believe it's ahead of itself on a price basis. But look, it's a momentum market. If I believe in the momentum, which I do, then you got to own the momentum stock. That's why people are coming into it. I think it plays out for a while and continues to march higher.
It's such a unique retailer in this environment, Josh. If you get back to whatever normal is, you have a winner. And then in a work-from-home environment where you want to be comfortable, you have a winner. And in a work-from-home environment or going back to work environment where you want to work out, you have a winner. That's why the stock is where it is. And now you have a street high 335 from Raymond James.
Yeah. Yeah, I think Weiss is going to make some money here. And this is one of the stocks that I hate myself for not having been smart enough to own. And we've got a house full of Lulu clothing over the years, and I knew it, and I just never bought it, or maybe I bought it and traded it. So I've made a big mistake here as well. One of the things that Lulu has going for it that almost no apparel retailer does right now is just this intensely loyal cult following. The customers know that other companies make athleisure. They don't care. They want Lulu. And they go to the website, they hit refresh, they want the newest stuff. If Lulu starts doing masks, everybody that's a Lulu customer is buying the masks. So they have that going on in a way that a lot of companies don't have in apparel, but you could find examples of that. And the best example of that is Netflix. Everyone knew there were all these, Nike too. Everyone knew there were other alternatives to Netflix, but people they want to watch Netflix. So I think like when you find a situation like this, it's hard to know when the love affair will end. But right now it's in full force,
and
I think the stock
services
was
between
higher.
the two
it's
countries.
moving as we speak.
As
You know,
that-
John, it is kind of a Nike-ish thing, right? I mean, other places sell the same kinds of apparel. It's just there's such a level of brand.
Or maybe Tokyo or Seoul. And Hong Kong is going to get squeezed. And on the back of this, you're going to see more demonstrations and more violence, and the Chinese government will suppress it. And that means the middle class and the business class in Hong Kong will be less robust. So this is unwinding. The question, David, is how precipitously, how quickly. And there, Trump's response, which of course has to be linked to what kind of market damage do I want to do in the few months remaining before my election, which is what I care most about, much more than American national interests and security. It's the same way Trump's going to approach the phase one trade deal. If he's going to break it, he's much more likely to break it in the weeks coming up to the election than in the months, when you're already seeing job numbers, the trajectory start to look better, and when the economic impact, negative of it, will not have such a great a playthrough on his own re-election campaign. So I think timing matters here in a lot of different ways.
So, Ian, finally, connect something, if it is connected at all, and that is the dispute between India and China on that border. That's also flared up at this time. Is that a coincidence? What's going on?
I mean, there have been some fisticuffs between the two. There's been a lot of posturing. The Indians have been building more infrastructure in contested territory. The Chinese have sent additional troops into the region. I would say right now it's definitely a concern because the economies for both countries are going badly and because the leaders are feeling kind of vulnerable. But Modi's approval ratings right now are actually quite high. They're around 80%. And he's been seen as a strong leader in response to coronavirus, both on the lockdown as well as on general nationalism, even though his economic response has been weak, in my view, so far. Xi Jinping does not need near-term confrontation with the Indians to ensure the sanctity of his position. He doesn't really want a big fight with India. So I think skirmishing, showing face on both sides. I'd be really surprised if this blew up, frankly. And so worth monitoring as everything is in this environment. But of all of the geopolitical tensions out there, Russia versus Saudi Arabia and the U.S. on the oil war, the vaccine fight, the World Health Organization fight, plus everything you and I have just been talking about, India, China would not be on my top 10 right now.
Okay, Ian, thank you so much. That's Ian Bremmer. He's the founder and president of Eurasia Group. And I'm delighted to say Ian's going to be back with us in the second hour of Balance of Power because we have the rest of the world to talk about. In the meantime, coming up here, we're going to talk with internet law expert. He is Jeff Kosef about the proposal from the president to curtail social media. That's coming up next on Balance of Power on Bloomberg Television and on radio.
In these times, this is a message from the government about the next stage of controlling coronavirus with NHS Test and Trace. To protect your friends and family, testing and tracing must become a new way of life. If you have symptoms, you need to get a test immediately. Don't leave home for any other reason. If you test positive, we will contact you to trace people who you might have infected. From now on, if you're told you've been exposed to an infected person, you must self-isolate for 14 days. Play your part and do the right thing so we can safely return to a more normal life. Go to nhs.uk or call 119. Stay alert. Control the virus. Save lives.
At Tesco, we've price-matched Aldi on hundreds of products like bananas, peppers, chicken breasts, mushrooms, Warburton's bread, strawberries, even avocados. That's Tesco products at Aldi prices. Because now more than ever, every little helps. Tesco. Prices checked on comparable products from GBLD. Online twice weekly. Price most often found matched excluding promotions. Selected Tesco stores excluding Express and all Northern Ireland stores. Products and their availability vary weekly and by store. Details at tesco.com/Aldi price match.
Okay, here we go.
With
the NFL draft in the books and the schedule set. Check out a TuneIn podcast for daily updates on the lead up to the 2020 season, like the Ringer NFL Show, where a rotating cast of Ringer experts talk with players, coaches, and special guests about the NFL landscape.
A lot of the other teams that we consider...
Or ESPN's NFL Live.
If there are some delays because of the COVID-19...
Search sports on TuneIn to explore these pods and much more.
Are you ready for the realest first-hand take of what's happening in the NBA? On their podcast, All the Smoke, former NBA players Matt Barnes and Steven Jackson bring their fiery intensity to the mic, dishing on the latest news and drama from on and off the court without boundaries.
Half man, half amazing. My friend, our brother, Vince Carter, man, welcome to the show.
Yo, what's up, man?
What's up, my brother?
Man, I'm good.
Search All the Smoke on TuneIn to listen.
Who says you can't have a laugh while getting serious about America's pastime? On the daily podcast Locked On MLB, comedian and baseball fanatic Paul Francis Sullivan talks about each team, each pennant race, and everything else in the game, from rule changes and controversies to baseball cards and stadium food.
For those of you who are not familiar with me or the old show, I love to obsess over baseball. I'm talking baseball over the Super Bowl. We had a TV showing the division series during my wedding.
Search Locked On MLB on TuneIn to listen today.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
Let's be honest, we all spend too much of our day on social media. But at least you can spend your endless scroll time to discover new things on TuneIn. Follow @TuneIn on Facebook, Twitter, and Instagram to always be in the know about the best new stuff streaming in the app. From breaking news stories and live sporting events.
He does! Fabry wins it!
To standout stations and podcasts. Stay in touch with TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
The NHL is always on the ice with these awesome hockey podcasts on TuneIn. Get your goal with the Spittin' Chicklets podcast.
Brian Yandel, Keith Yandel, thanks for coming on. What's going on?
Nothing much. Glad to be here. You guys got some nice digs here.
We heard you took Southwest 2-stop flight to get out here.
Yeah, well, I just...
Carve up the ice with NHL at the rink.
The other day, I wrote a story. Artemi Panarin, Semyon Varlamov, Sergei Bobrovsky, they all helped arrange for the purchase of N95 masks to benefit hospitals in their respective markets. This is another one of those positive stories you're seeing.
Or create your own power play with Locked On NHL.
All these teams invested future assets to take a run at the Stanley Cup right now. Like, all of those teams would have a real serious gripe, like trading these multiple first-round picks to make a run at a cup. You're right.
Discover these and more NHL podcasts right here on TuneIn.
Buckle up, race fans.
NASCAR is back in the driver's seat.
And you can cut straight to the action here.
With the Performance Racing Network on TuneIn, you can hear PRN's live coverage of some of this year's top events.
As NASCAR's top drivers, Kevin Harvick,
Clint Boyer, and more get back on the track.
Search Performance Racing Network to listen and see upcoming races.
Wondering what to play next? Want to know what other TuneIn listeners are listening to right now? Head to the trending section under Browse to explore the most popular stations and podcasts on TuneIn today. Millions of listeners like you can't be wrong.
Be protected by Section 230. But if a website decides to take down some of the defamatory comments and not all of them, that is something that Section 230 will protect. So it's basically Section 230 gives these platforms the breathing room to make moderation decisions or not to make them.
So Section 230, as you say, is part of a statute passed by Congress, signed by the president. The initiative under the executive order, as I understand it, is regulatory in nature. How much authority does the executive branch have to modify or its enforcement of 230 without going back to Congress?
Well, I mean, I think that the broader issue here, and I mean, this has been going on for the past few years, is that there have been a lot of criticism of Section 230 from various points of view. Some people who say that the platforms do too much moderation, and others who say the platforms are not moderating enough and they leave up harmful content. And I mean, I think that all of this is laying the groundwork for efforts to repeal Section 230 altogether. I think there's what I've seen is there's a substantial amount of support on various sides of the political spectrum for a repeal of Section 230.
So, Professor, give us a sense of what that might do as a practical matter. In 1996, there were tens of millions of people on the internet. Now there are billions of people globally. If you took that back away, what would happen to social media? Could it survive in that environment if it were liable to be sued for things posted by other people?
Well, so we don't exactly know how social media and other platforms would react to a full repeal of Section 230 because the modern internet has always existed with Section 230 in place. There are a few different options. One possibility is that platforms might be a lot more restrictive about what user content they allow because they're just afraid of being held liable for every word that users post. However, there actually is a line of cases before Section 230 was passed, actually really just one substantial case, where the court suggested that you actually increase your First Amendment protections if you don't do any moderation at all. So it's hard to say with any certainty because, again, we've just always had Section 230. But there is a chance that platforms either just might not moderate or they might not allow much user content at all just because of the fear of liability. But the current platforms and how they operate, for good or bad, really have based their business models around Section 230's pretty robust protections.
Okay, Professor, really appreciate your time and your expertise today. That's Professor Jeff Kosef of the U.S. Naval Academy. Coming up here, we're going to talk about that tragic situation in Minneapolis with former Minnesota Senator Norm Coleman. That's coming up next on Balance of Power on Bloomberg Television and on radio.
To be in the markets now, you need nerves of steel.
I mean, we're not supposed to be hysterical.
And Bloomberg surveillance.
Let's just start with something extreme.
What are you comparing this to?
Bloomberg surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A lot of economists are just throwing up their hands and saying, we don't know.
Weekday mornings at 7 Eastern.
Your call, your message to your clients on a morning like this morning.
On Bloomberg Radio, the Bloomberg Business app, BloombergRadio.com, and now watch us on Bloomberg Television.
Hi, everyone. Al Roker here. As a guy with his own catchphrase, I appreciate that after 75 years, Smokey's only said,
only you can prevent wildfires.
But I'm filling in because there's a lot more to report. Like when it's dry or windy. Be careful burning yard waste, because wildfires can even start in your neck of the woods. Go to SmokeyBear.com to learn more about wildfire prevention. Brought to you by the U.S. Forest Service, your state forester, and the Ad Council.
Have you wanted to speak a new language, but you thought it'd be too hard or take too much time? Then go to Babbel.com, download the app, and try it for free. In just 15 minutes a day, you'll be on your way to speaking a new language in just a few weeks. And right now, you can try Babbel for free. Babbel starts out teaching you words and phrases by matching them with pictures. You won't believe how easy the interactive program is. Soon the sentences get a little bigger, and before you know it, you're having simulated conversations voiced by native speakers. And because Babbel is crafted by language experts and uses the spaced repetition method, in just 10 to 15 minutes a day, you'll be speaking the language of your choice with real confidence. With Babbel, you can speak a language. Just go to Babbel.com and start your first lesson in the language of your choice for free. Download the Babbel app or go to Babbel.com and try it for free. That's Babbel.com.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. As we said earlier in the program, our colleague Mike McKee got an exclusive interview with Loretta Mester. She's the Cleveland Fed president earlier today. And besides talking about yield curve control, they also talked about what's coming up in the rest of the year, like the second quarter. This is what she said.
The second quarter numbers, when they come out, are going to be very, very negative numbers. I mean, we know that. We know that that was the height of the shutdown when there was no activity. in the third quarter and fourth quarter, we're going to see activity begin to emerge. I think some of the quarterly growth rates are going to overstate what it looks like really out in the field, because we're going to see from a base of very little activity some pickup in activity, and they're going to look like big growth rates. But we're still going to be below where we were at the start of the year in terms of both employment and output. When you have so many people out of work, it's hard to imagine that we'd see a quick V-shaped recovery. I think it's going to be slow. I think businesses are going to be thoughtful about reopening. I think people are going to be thoughtful about spending. And so that means is that monetary policy has a role to play as we support the economy, getting back to our dual mandate goals of full employment and price stability. And so that's more traditional monetary policy, and the tools that we have are our interest rate tool, which already is at zero, forward guidance, which we've used before, and also asset purchases, but asset purchases not to improve market functioning, but really to support the economy as it moves forward towards full employment and price stability.
Well, President Mester, at the moment, there are people worried about how big the Fed's role is in clearing markets now and how big the Fed's role is in setting prices. And there's been a conversation in the last several weeks with us and your colleagues, including President Williams, about yield curve control. I want to try and understand from you, because this is where the confusion is on Wall Street for some people in fixed income at the moment. Would yield curve control for you be something focused on the front end, the belly of the Treasury curve? Or would you think about doing what Japan is doing, which is all the way out to 10 years? Just how much control over the yield curve, so to speak, would you be looking to have?
Right. So my view of yield curve control is that it really is a support for forward guidance if we were going to do it. Now, the committee has discussed yield curve control as a tool back in 2010 during the financial crisis, and then also as part of our framework review as a tool, a potential tool. No decisions have been made on that at all. Again, I don't think of that as something that would be in this phase of what we're doing to make sure that the markets continue to function. But as a tool, I think it's worthwhile thinking about what those tools are going to be that we can use. But right now, that's a discussion for the future phase. And my own view is that if you wanted to do it, you'd have to think hard about how you would implement it. And also, as I said before, how do you exit from it? Because with any of these tools, right, there are pros and cons of using them. Right now, as you point out, the yield curve is very flat at the short end. So maybe with the forward guidance we've given already, it's not necessary to do something to emphasize that forward guidance. But I don't want to take it off the table as something that's a potential for me to think about as a possible tool. I just don't see that we need it here in this space, nor do I see going forward that we necessarily would need to use it. But if we were to use it, I would view it as a reinforcement for forward guidance on the short end.
Before we let you go, I have to ask you about this. There is the possibility we could end up in a new trade war with China, additional tariffs going on. How would that affect the economy? Have we already absorbed that, or would that be a new hit to the economy now?
Well, I think, whenever there's a new rising up of uncertainty, and this is another uncertainty, I think we have to take it on board as being another potential headwind to a recovery. So I think we have to just use that as part. We have to take the conditions as they are. I think that we played this game before and sort of saw how the uncertainty did dampen the expansion earlier. And so I think we have to just take that on board as this is another uncertainty added to an incredible amount of uncertainty we already have.
That was Cleveland Fed President Loretta Mester talking with our colleague Michael McKee and John Farrow earlier today. I'm delighted to say we have Michael McKee back now. He is our Chief Economic and Policy Correspondent. So, Mike, the thing I'd really like to focus on with Loretta Mester and what she said about buying assets to really help the economy, not really to affect the market. And also we heard from Fed Chair Jay Powell saying, we will insert money, but it's for lending, it's not for spending. Is that really a difference? Does that difference hold up? They're making a big effort to say we're really not doing sort of monetization.
Yeah, they want to make it clear that we need more fiscal help. The Congress needs to do something to help stimulate the economy. The Fed can lower interest rates, and they're doing these lending programs, but they are lending programs. In theory, they're supposed to be paid back. And the Fed, by statute, can't lose money, which is why the Treasury participates in this. If anybody loses anything, it'll be the taxpayers. But they want to make it clear that we need more stimulus. The Fed will probably do something to keep interest rates lower. But if you really want to get money into the hands of people and get them out spending, that's got to come on the fiscal side.
Well, if that's part of the issue, isn't it? Because we heard from Fed Chair Powell that a lot of the issue, particularly if there's a second wave, is going to be consumer confidence. I'm not sure the Fed can make the consumer feel better.
No, if you're worried about catching coronavirus and dying, you're not going to really go out and buy something because the interest rate on it is about 10 basis points lower. So the Fed has done about all they can do in this case to lower interest rates, lower the cost of money. Their next steps would be to keep that cost of money lower and maybe to boost the stock market in the hope that the wealth effect would trickle down to people and they would feel like they could go out and spend. That was the original purpose of QE. They say that's not what they're doing now, but they could aim it that way.
Yeah, and it's fascinating that as they sort their way through this thing, they may actually be helping fiscal stimulus in a way by keeping the rates low because the Treasury can borrow money cheaper.
It all fits together. If the Treasury can borrow money more cheaply, then they might be more encouraged to do so, to spend money. We know that the Republicans who've worried about the budget have now expressed concerns about spending more money. So reassuring them would at least help in perhaps getting their vote for a fourth round of aid.
Okay, thank you so much to Michael McKee for 2 appearances today on Balance of Power. It was a real treat to have you, Mike. In the meantime, there is a headline as we go to break here. It says that President Trump is weighing sanctions on China finance sector over Hong Kong, something that has been rumored but really would be quite dramatic potentially about Hong Kong. That does it for Balance of Power on television. We're going to go over to radio now and have a second hour. This is Bloomberg.
This is a Bloomberg Pursuits look at luxury. Stanley Ho, the 98-year-old tycoon who built the Chinese territory of Macau into the world's biggest gambling hub, left 16 recognized children with 4 women behind when he died. Now Pansy Ho, the 57-year-old eldest daughter of his second wife, looks to be taking over the reins. The pressure is now on Pansy to unite the interests behind the Ho family's $15 billion fortune, rejuvenate an aging casino franchise, and lead the empire through the coronavirus pandemic that's caused gambling revenue to plunge more than 90%. Also charting a careful path forward, the Coachella Music Festival. Concert promoters are asking artists lined up for the annual Coachella Music Festival to play in 2021 instead. The clearest sign yet that the largest music festival in the U.S. will be totally canceled. Coachella draws 200,000 guests and as much as $100 million in sales for promoter Golden Voice and its parent AEG. I'm Andrew O'Day, Bloomberg Radio.
You're living in a world built on science, political and economic.
You've got to believe the labor market gets hit.
Computer and medical.
Clarify where we are on a test.
It all makes a difference.
What do you think needs to happen in terms of governmental response?
And it's all here.
He expects the virus to peak quite a long time from now.
Get your science straight.
The hand-washing campaign, is this actually a good strategy?
Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening.
To protect his home and family from disaster, Steve used courage, wisdom, and his camera phone.
That should do it.
Way to go, Steve! By simply taking digital pictures of his family's important documents, Steve can always have them stored safely online, no matter when disaster strikes. Learn other simple ways to protect your home and family before a natural disaster at ready.gov. That's ready.gov. A message from FEMA and the Ad Council.
NJIT, New Jersey Institute of Technology, makes innovation happen. NJIT faculty mentored Christoph Camacho when he was a student, helping him co-found a startup and patent a device that uses drone technology for reforestation and to collect valuable data for land management.
I founded Paratrees back in 2016, taking what I learned from my research at NJIT and migrating it to a startup. Our technology is to really enhance land management operations. So we work very closely with land management companies. So we have a drone that performs precision reforestation, and we do storm damage assessment. Having access to drones that can collect data so it's much faster. And what is more important, we help them drive management decisions. NJIT has been there every step of the way, going full force with my company.
NJIT, New Jersey Institute of Technology. Learn more at njit.edu.
From the financial capital of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. A move lower for the Dow, the S&P, NASDAQ turning around, NASDAQ now higher. Bonds are advancing as investors weigh the biggest drop on record in American consumer spending. They're also awaiting a presidential news conference. 2 p.m. President Trump will be speaking at a news conference. The president is weighing sanctions on China's finance sector over the Hong Kong dispute. Right now, NASDAQ is up 14, a gain of 0.2%. The S&P down 12, a drop there of 0.4. Dow Jones Industrial Average down 184 points. That is a drop right now of 0.7%. 10-year is up 8/30 seconds with a yield of 0.66%. We've got gold up 0.9%, higher by $15 the ounce at $17.33. And crude oil pulling back now by 1.2% with more on commodities trading, specifically crude. Here's Bloomberg's Renita Young.
Crude oil is caught up in the broader negative sentiment around deteriorating U.S.-China relations, and gold heads for a second monthly gain amid the same concerns. Meanwhile, the scramble to jump on one of the hottest gold trades in years by shipping bullion to New York has sparked what may be one of the largest ever physical transfers of the metal. Renita Young, Bloomberg Radio.
And right now we do have gold trading higher by 0.9%, $17.34 the ounce. It is up $16. 102 on Wall Street. Time now for the Market Drivers Report with a focus on American depository receipts. Here he is, working from home, Dave Wilson.
Thanks, Charlie. ADRs are falling more than U.S. shares. The S&P ADR index is down 1%, and the S&P 500 is lower by 0.5%. UK banks relying on Asia are lower after Chinese lawmakers approved new security rules for Hong Kong. The legislation had sparked the city's biggest street protests since last year. HSBC Holdings has dropped 3.5% in U.S. trading, and Standard Chartered has fallen 6.6%. France's Renault has lost 6.3%. The automaker plans a 3-year overhaul that will eliminate about 14,600 workers and reduce production capacity by about 20%. ADRs of Renault's Japanese affiliate Nissan Motor have declined 5.8%. Brazil's Embraer has risen 6%. Reuters reported that the regional jet maker has drawn takeover interest from Chinese and Russian aircraft companies. The story cited unnamed people familiar with the matter. Now, Boeing scrapped a deal with Embraer last month. And the UK's Adaptimmune Technologies has soared 143%. The drug developer presented favorable data from early-stage studies of a proposed cancer treatment. Charlie?
All right, we thank you very much. Dave Wilson following those ADRs for us. After earnings, Dell up 6.9%. Salesforce.com is down by 5%. Recapping equities mix, NASDAQ higher, up 9. Dow, S&P lower, S&P down 14, down by 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This is Balance of Power.
Everybody in the world has one common enemy, and that's to win the war against this virus.
The first thing you do is listen to the medical professionals.
Those people that lost their pay, we want to see that pay continued.
Where the world of politics meets the world of business.
Our priority is the health and well-being and the lives of the American people.
We want to make sure that we are continuing to support our hospitals.
We've unleashed our most potent weapon of all, the courage of the American people.
Balance of Power with David Weston on Bloomberg Radio.
President Trump is reportedly, quote, furious with China and will lay out plans to punish it in about an hour's time. The president's fury with Twitter doesn't appear to deter it from commenting on his tweets. And even in a time of global crisis, there's a shortage of coordinated action, much less cooperative action. From New York, welcome to the second hour of Bloomberg Balance of Power. I'm David Weston. The world is facing some major challenges that could use a bit of cooperation among countries. And it isn't limited to fighting a global pandemic. It extends extends to things like a collapsing oil market and trade and technology transfer. But just when we may need it most, multinational efforts seem to have moved to the sidelines. Ian Bremmer, founder and president of Eurasia Group, calls it G0, and he's back now for the second hour of Balance of Power. So, Ian, comment on this. I think you coined the term G0 as opposed to G20 or something. What is causing this utter lack of cooperation right now, it would appear, among nations?
Well, I coined it back in 2011. I've seen this coming for a while, and there were a lot of reasons for it. One being that the Americans were increasingly less interested in playing the role of the global sheriff or the architect of global trade or even the cheerleader of global values because of our own growing inequality and our failed wars in Afghanistan and Iraq and people angry about open borders and free trade and losing jobs and lots of immigration, all those things. We saw that happening in Europe, too. Our most important allies were becoming more divided and weaker. Brexit was the key example, but the rise in populism across the European continent is part of it. And you also saw it, most importantly, with the rise of China. For so many decades, Americans thought that when China got wealthier, they'd align with our political values and our economic system, and they haven't. Xi Jinping is doubling down on state capitalism, and he's consolidated power in terms of an authoritarian system. So those are the underpinnings for a G0 world. But of course, you don't pay as much attention to that evolution in geopolitical power when you're making money and things seem fine. But suddenly when there's a crisis and when you really need international coordination, then everyone looks around and says, oh, my God, like these institutions don't work very well. Where's the leadership? Well, it's been a long time that we've lost this leadership. But now is when it suddenly matters to people.
So we talked about China in the first hour, and I want to go on to other places. But since we talked, there's a report now that President Trump is considering sanctioning the financial sector in China. Address the Chinese issue from a different point of view. Could we use a little help from our friends?
Yes, we could. And I mean, one of the biggest challenges I have with the Trump administration's approach to China is not that their arguments are misplaced against the Chinese, but rather that America first has frequently translated into unilateralism. And so, I mean, the Australians are every bit as angry as the Americans with the initial cover-up of the coronavirus in China, and they launched their own investigation. It wasn't coordinated with the U.S. at all. Why not? When we're telling the Europeans we don't want them to use Huawei, and there are good reasons why the Europeans shouldn't want to use Huawei for their 5G system, but we haven't coordinated an approach. And I've actually been quite pleased to see just in the last couple of days that the UK has said that we should have a multilateral approach to work on an alternative to China 5G together. And they said, and they have the Australians, the Americans, the Canadians, and the Brits so far in that group. I'd love to see that expand. Of course, you'd like to see multilateralism like that emanate from Washington, because if we start it, we're more likely to set the rules.
And what about the pandemic itself? What is the level of cooperation or not cooperation? And not just in investigating what happened with China, but in coming up with a response.
Well, the World Health Organization is, of course, the organization that is entrusted with responding to pandemics globally. It certainly needs reform. It's weaker than one might like in this environment. And it's also gun-shy because they raised the alarm pretty strongly after SARS, and they got a little burned for that. A lot of people said, we ended up taking a lot of measures that we didn't really need, and it cost a lot of money. Easy to make that argument when you end up okay. But the idea that the United States would try to gut the WHO and remove funding during a pandemic is obscene. Right. I mean, that is not where we should be. And of course, on a vaccine, it's a global virus. We need a global vaccine. Everyone needs to be vaccinated, because if they're not, we're going to still have the disease, and we're going to have travel restrictions, and the global economy won't function fully. But instead, what we have is 110 different approaches, some of which are nominally global and would go to everyone in equal way, though the rule set isn't clear on that yet, some of which are very clearly supported by governments like the United States and China, and they'll make sure that their citizens get it first. And so the fight that we'll see over vaccine nationalism, as we hope vaccines that are successful start to be developed in 2021. And, of course, no guarantee for that. By the way, David, the fastest a vaccine has ever been developed for a new disease in the past was bumps, and it took 4 years. So, I mean, this is a hell of a lot faster. We've got a lot better human capital this time around. But assuming we do get a vaccine, a G0 is a really hard time to roll one out.
So we're going it on our own to a significant degree, and that, frankly, has been what President Trump has said he wanted to do from the beginning. He hasn't been shy about that. It's not a secret. Where does the United States come out of this pandemic in terms of geopolitical status?
Well, you know, even though there's all this unilateralism, the United States is still the most powerful country in the world. And, you know, no matter what the president says, Trump doesn't undermine that reality. So, I mean, the fact is that technology companies are going to come out of this crisis a lot stronger. The bricks and mortar and real economy companies are going to be weaker. And this is how you and I are doing this interview right now. Yeah. And it's how knowledge economy continues to work robustly. It's how Amazon, thank God, because otherwise how would we be getting stuff while we're in quarantine? Well, I mean, the Americans dominate that field, and our allies don't. The Chinese are the only other country out there with serious tech firms. So that's going to make the U.S. stronger. In an environment where you're going to see more nationalism over things like energy and food, the U.S. is the world's largest producer, and we export. Our reserve currency is likely to be stronger coming out of this as opposed to weaker. So, again, we'd be in an even better position if we were doing that in coordination with our allies with more trust and stronger relations. But it is interesting to note that the asymmetry in power between the U.S. and allies is going to be exacerbated / enhanced coming out of this crisis.
Fascinating. Thank you so much, Ian. It's always a treat to have you with us and for both hours of Balance of Power. That's Eurasia Group's Ian Bremmer. Coming up, does the president really want to shut down Twitter? Tim O'Brien of Bloomberg Opinion has his doubts about that, and he has some personal experience with Donald Trump that he thinks supports his side of the equation. That's coming up next on Balance of Power on Bloomberg Radio.
Whether it's another day of market misery, pandemic emergency, or both, one thing will still go right.
We have the latest world and national news.
Karen Moscow and Nathan Hager bring you the most accurate coverage.
The White House is looking for additional ways to support the economy.
Bloomberg Daybreak.
We continue to watch equities around the world.
Weekday mornings at 5 Eastern on Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening.
Not completing high school is more of a social thing than it was an academic thing. Even though all these years have passed, I still had that longing to have my diploma.
At age 30, Carissa finished her high school diploma.
If you're even considering getting your high school diploma, you can do it.
No one gets a diploma alone. If you're thinking of finishing your high school diploma, you have help. Find free adult education classes near you at finishyourdiploma.org. That's finishyourdiploma.org. Brought to you by the Dollar General Literacy Foundation and the Ad Council.
COVID-19. Can the world reopen for business?
Give us a sense of how you're ramping up and taking care of folks on the ground.
What's the long-term impact?
Why will we not see a V-shaped recovery?
When will there be a cure or a vaccine?
How can you model that at a time when it's unclear whether we're going to see a resurgence in viruses?
The answers will emerge.
Can you give us a sense of timing?
And you'll find them here. Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening.
There are everyday actions to help prevent the spread of respiratory diseases. Wash your hands. Avoid close contact with people who are sick. Avoid touching your eyes, nose, and mouth. Stay home when you are sick. Cover your cough or sneeze. Clean and disinfect frequently touched objects with household cleaning spray. For more information, visit cdc.gov/COVID-19. This message brought to you by the National Association of Broadcasters and this station.
In-depth analysis.
Where will 2020 take you? Somewhere where people care about each other, about our planet, about creating a better world for everyone, and becoming the best versions of yourselves. Join a community of like-minded individuals at the University of Winchester. Make sure to accept your offer by the UCAS deadline and visit our website to find out more. See the bigger picture. Be the difference. Go to winchester.ac.uk.
This is an important update from the government about coronavirus.
We all need to stay alert so we can control the virus and reduce the risk of infection. Staying alert means you must stay at home as much as possible. Work from home if you can. Limit contact with others. Keep your distance if you go out. And wash your hands regularly. Do not leave home if you or anyone in your household has symptoms. Stay alert. Control the virus. Save lives.
Are you ready for the realest first-hand take of what's happening in the NBA? On their podcast, All the Smoke, former NBA players Barnes and Steven Jackson bring their fiery intensity to the mic, dishing on the latest news and drama from on and off the court without boundaries.
Half man, half amazing. My friend, our brother, Vince Carter, man. Welcome to the show.
Yo, what's up, man?
What's up, my brother?
Man,
Search All the Smoke on TuneIn to listen.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
Who says you can't have a laugh while getting serious about America's pastime? On the daily podcast Locked On MLB, comedian and baseball fanatic Paul Francis Sullivan talks about each team, each pennant race, and everything else in the game, from rule changes and controversies to baseball cards and stadium food.
For those of you who are not familiar with me or the old show, I love to obsess over baseball. I'm talking baseball over the Super Bowl. We had a TV showing the division series during my wedding.
Search Locked On MLB on TuneIn to listen today.
Looking to freshen up your listening on TuneIn? Head to the homepage to discover something new. There you'll see custom recommendations based on your listening habits, along with new episodes of shows you've enjoyed in the past. Uncover your next audio obsession on the homepage.
Brian Windhorst and the Hoop Collective Podcast.
What about Giannis Antetokounmpo? He is going to be eligible to sign a Supermax extension, which we were projecting to be worth $240 million this summer. Well, if the salary cap drops, and even if he's wonderfully happy in Milwaukee, it may make no sense for him to sign when he can just wait a year and wait for the revenues to recover and then lock in.
Subscribe to Brian Windhorst and the Hoop Collective.
Search the Hoop Collective to listen.
4 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. We begin with a number of headlines from the Bloomberg Professional Service. New York Governor Andrew Cuomo says New York City is on track to reopen in 2 weeks. Cuomo says the reopening phase 1 could begin June 8th. And repeating an earlier headline, President Trump has discussed targeting China's financial sector through sanctions and trade policy in retaliation for Beijing's moves to curb Hong Kong's autonomy, this according to people familiar with the matter. It is a mixed day for the U.S. equity market right now. We've got the Dow and the S&P. They are both trading lower. NASDAQ is higher. Let's begin there. NASDAQ up by 13 points, a gain of just about 0.1%. S&P slumping 15, down 0.5, and the Dow pushing lower, down 209 points, a drop of 0.8%. Investors weighing the biggest drop on record in American consumer spending. 10-year up 10/30 seconds, yield now 0.65%. Gold up 1%, $17.35 the ounce. And crude, West Texas Intermediate down 0.3%, $33.62 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It's time now for Bloomberg Opinion, and we welcome senior columnist Tim O'Brien. Thanks to Bloomberg. Okay, Tim, you got a great column out that Jack Dorsey's going to like, I think. The headline is, Twitter has little to fear from Trump. And let's be frank, you've spent some time with Donald J. Trump, so you know of where you speak, I hope. So why is it that Twitter shouldn't really be afraid of the president?
Well, David, I think once again he's rattling his saber here. I think he and Twitter are almost codependent. You know, Twitter's financial fortunes and its public footing have both improved dramatically since Trump became president because he's a ubiquitous presence on the platform, and I think he personally can't let go of it. It's almost like a toy he won't want to break. I think that's what's going on the personal side of the ledger. On the legal side, it would be very hard for the Commerce Department, the Justice Department, and Trump himself to weaponize regulations and the Constitution in a way that they could effectively force Twitter to post the kind of content that the administration wants it to. And oddly enough, in the executive order that Trump released last night, calling for a crackdown on Twitter, he's ultimately arguing that Twitter should police the very kind of posts that Trump himself puts up on Twitter almost daily.
So I do want to talk about the legal issues, but let's talk about the personal first, because, as I say, you're a rare creature, at least in my experience. You've spent a fair amount of time with this man. I think he sued you at one point, in fact. And you've got a great story in your piece about riding in a car with him when he explained to you just how important the media is to him.
Right. That was back in 2005, and I think one of Trump's skills and strengths that has decades of empirical evidence behind it is that he has always understood how to get around the media and to go directly to his fans or his critics. And in the 1980s, the 1990s, that was page 6 of the New York Post. It was the business press. It was television talk shows and the like. And he could pick up his phone and usually get airtime whenever he wanted it. And he knew how to use that access to get his own point of view out into the world. And that was well before the advent of social media. And he and I were driving around together once to one of his golf courses in 2005 and just chatting about a bunch of stuff. And at one point he turned to me in the car and he said, essentially what he said is, I have my own printing press. I have an ability to go around the media, so I really don't care how I'm covered because I can respond, and a lot of people who are public figures can't, and I have that power. And certainly, and that was pre-Twitter, pre-Facebook, pre-Instagram, and those platforms have given him and many other people in society a much more direct channel into the American psyche and the American conversation, and he's taking great advantage of that. But really what he's doing is using skills that he's honed for decades on a modern social media platform.
So what is it, as far as you know, that's really bothering the president here? Because it struck me as ironic. He's talking about censoring. But at this point, his complaint with Twitter is not that they took anything down that he put up. They put it all up. But that they added to it and said, by the way, you might want to read this other information about whether, in fact, there's fraud involved in mailing in ballots or not, after he'd posted that it's all fraudulent. So what's his complaint? He still has direct access to the people. Is he just complaining that he should get it and nobody else should be able to comment on it?
His complaint is that he was fact-checked, and he doesn't like being fact-checked. We've seen this in the Rose Garden, by the way, when he does press briefings, and he talks about steps the White House has taken to combat the coronavirus epidemic that is greatly at odds with the facts. And when reporters contradict him live in the Rose Garden, he immediately gets discomfited. And his debate with Twitter right now is just a digital version of that. He doesn't like to be questioned. And that's an interesting dynamic here, too, because for as much as he loves to bask in the media spotlight, he is so insecure that the minute the media questions him, he loses his composure and goes into attack mode.
At the same time, he has benefited from various people, including the media, underestimating him time after time after time. Is it possible that what he's really doing here is the equivalent of yelling at the NBA ref, hoping the next call will go their way? That is to say, really giving Twitter a tough time, hoping that they'll, on the margin, sort of back off a bit.
This has been his MO again for decades, David. Newspapers have had to contend with this with him too. Does his barking have a chilling effect on the way that the media covers him? And undoubtedly sometimes it does. I think net with certain writers it hasn't. I think each institution's developed their own posture towards him. I think Twitter and other social media companies are having to come to terms with the reality that they're not just technology platforms, they are news publishers in my view. And they have to start to think about what that means when they have someone like President Trump coming at them so directly. Now, he issued the executive order last night on Thursday, and overnight he posted a tweet basically threatening to send the military into Minnesota, and Twitter essentially masked that tweet, and so they felt it promoted violence. So they clearly, at least in the moment, haven't backed down.
But they left it up. They just said it violated their terms because it encouraged violence. I mean, it's interesting. It's still left up. Tim, it's really great to have you on for so many reasons, but particularly when it comes to Donald J. Trump. That is Bloomberg Opinion senior columnist Tim O'Brien. You can read more on this and other stories from Bloomberg Opinion at Bloomberg.com/opinion and on the terminal by typing in OPIN GO. Coming up, more on tech versus the president with Carly Fiorina, who after all did run tech giant Hewlett-Packard. That's next on Balance of Power on Bloomberg Radio.
This is a Bloomberg Money Minute. U.S. stocks are mostly lower on a decline in consumer spending. The Dow is down 210 points, S&P dropping 15, but the Nasdaq is up 8 points. Consumer spending fell a record 13.6% in April. We cut spending on all but the essentials amid the shelter-at-home orders. The discount chain Big Lots prospered as we stocked up at the start of the pandemic lockdowns. Quarterly earnings easily beat forecasts. Sales were up more than 10% from a year ago. Uber is close to a deal to buy Grubhub. Sources say talks are now down to a fee that Uber would pay Grubhub if antitrust regulators block the deal. And President Trump is going to hold a press conference shortly that will reportedly outline some of the measures he's planning to take against China and its leaders. Donna Wilson, Bloomberg Radio.
The possibility of lung cancer can be pretty scary, especially if you're one of approximately 8 million current or former smokers at high risk. That's why SaveByTheScan.org wants you to know that now there's a breakthrough low-dose CT scan that can detect lung cancer early, and it only takes 60 seconds. You stop smoking, now start screening. For an easy quiz to see if you're eligible, visit SaveByTheScan.org. It could save your life. SaveByTheScan.org is brought to you by the American Lung Association's Lung Force Initiative and the Ad Council.
If knowledge is power, the Bloomberg Terminal is your power up, connecting you to real-time financial data, market-moving news, powerful analytics, and an influential network of financial decision makers around the world. Share ideas, negotiate trades, and gain the insight you need to make more informed decisions. See how the Terminal can take your workflow to the next level at Bloomberg.com/professional.
How long? This is a message from the government about the next stage of controlling coronavirus with NHS Test and Trace. To protect your friends and family, testing and tracing must become a new way of life. If you have symptoms, you need to get a test immediately. Don't leave home for any other reason. If you test positive, we will contact you to trace people who you might have infected. From now on, if you're told you've been exposed to an infected person, you must self-isolate for 14 days. Play your part and do the right thing so we can safely return to a more normal life. Go to nhs.uk or call 119. Stay alert, control the virus, save lives.
What do you do to be an everyday superhero, like Mary?
So I know it's tempting to pour used cooking oil straight down the sink, but I spoke to the local council and they said the best way to get rid of oil or fat is to collect it, once it's cooled down, of course, in a used container. And then you can scoop it out and put it in the bin.
Cooking oils and fats block thousands of pipes every year. Save our sewers, rivers and seas by putting them in the bin, where they belong. Visit thameswater.co.uk/bin it. Together, we can care for the environment.
This is a message from the RNLI and Her Majesty's Coast Guard. Beach lifeguards can't be everywhere this summer, so they can't always protect your family, but you can. So keep an eye on your loved ones. Avoid taking risks in the sea. Don't use inflatables. In an emergency, dial 999 for the Coast Guard. Get more advice at rnli.org/beach2020. Thank you.
Are you fully informed on the NBA? On the NBA Hangtime podcast, veteran sports writers Sekou Smith and John Schumann analyze the latest NBA news, storylines, and discussions with guests from around the basketball universe.
Isaiah Thomas joined us here on the Hangtime podcast. Isaiah, good morning.
Everybody's doing well. As you know, my daughter tested positive.
Search NBA Hangtime on TuneIn to listen.
Want to relive the glory of college football?
Balls over a man, into the end zone.
Gonna
Come explore TuneIn's classic game replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 bowl games. Don't miss your chance to re-experience the Rose Bowl, the 2020 National Championship, featuring Clemson and LSU.
There's going to be 2 champions on the field tomorrow night. There's going to be 1 team hold up the trophy.
Pass to the 5! Touchdown! Search classic game replays to listen for free.
With the NHL season temporarily on ice, now is a good time to catch up on past games.
It's that score, Malkin again! Bergeron, he scores!
With game replay on TuneIn, you can listen to every power play, slap shot, and goal of the 2019-2020 season so far.
Suter to Cunnin to Fiala, he scores!
And for a limited time, it's free for hockey fans everywhere. Search classic game replays to start listening. Get your MLB fix with these great podcasts on TuneIn. Fill your 7th inning stretch with the Ringer MLB Show.
I just can't get over it. It's like, oh, well, Jeter Downs. Didn't realize he was a top. Like, my dad is drinking the Kool-Aid on this. He's like, of course. Mookie was going to leave. I'm like, what do you mean? You don't know that.
Slide into second with the Starting 9 podcast.
Nolan Arenado slides right into the top spot for a favorite baseball player. Active in the league right now. It is a pleasure to be sitting next to you, sir.
Thank you, man. I appreciate it. Thank you.
This is, we've been waiting a long time for this. We actually, in terms of like active
Round the Bases with the StatCast podcast.
Ways of going about it. I picked third, so in some ways it made it easier for me. Mike, just to go over the first couple of picks, Mike took Barry Bonds, who I think was kind of the obvious guy to take number 1, not only.
Catch these and more MLB podcasts.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119 and around the globe. The Bloomberg Business app and BloombergRadio.com. This is Balance of Power with David Weston.
Coming up on Balance of Power, what does a tech CEO do when the president has declared war on the company? We talk with Carly Fiorina, founder and chairman of Carly Fiorina Enterprises and Unlocking Potential. But first, let's get a market check with Charlie Pellet.
And thank you very much, David Weston. Here's what's going on. We have got the Dow, the S&P, both lower. NASDAQ is pushing higher. NASDAQ up 11. That is a gain of 0.1%. S&P down 15, a drop now of 0.5%. The Dow is down 215, a drop of 0.9%. Stocks push lower, bonds advanced as investors weighed the biggest drop on record in American consumer spending, and they are awaiting President Trump's news conference coming up 2 o'clock Wall Street time. Consumer spending posted a record drop, and with that story, here's Bloomberg's Vinny Del Giudice.
The University of Michigan says consumer sentiment faltered in late May as Americans took a dimmer view of the economic outlook. They've also cut back on household expenses with stay-at-home orders fueling a record decline in consumer spending. Meantime, merchandise trade fell to the lowest in a decade in April as the coronavirus cut demand and supply lines. Retail inventories are also down. Vinny Del Giudice, Bloomberg Radio.
The 10-year up 930 seconds with a yield of 0.66%. Gold up 1%, 17.35 the ounce. West Texas Intermediate crude now up by 0.1%, 33.74 a barrel. In the oil patch, getting the word that Occidental Petroleum cutting its quarterly dividend to 1 cent a share from 11 cents. That is a slash of 91%. Again, Occidental Petroleum slashing its dividends, now 1 cent a share. Shares of Occidental, they are down by 3.2%. Gold up 1% right now, 17.35 the ounce. Recapping equities mixed with the S&P down 14, down 0.5%. I'm Charlie Pellet. That's a Bloomberg Business Flash. Balance of Power continues. He made it through the week, the Friday edition. Here's David Weston.
Yeah, almost. I have a little more to do, but thank you so much, Charlie Pellet. President Trump's war with Twitter escalated in the last 24 hours with his signing an executive order pointing toward removing legal immunity for social media and then posting a tweet about riots in Minneapolis suggesting troops should fire on looters, which led Twitter promptly to put a note on his post that ordinarily they'd take take it down because it violates policies against encouraging violence, but that it would leave it up because the public should see it. We welcome now Carly Fiorina, former CEO of Hewlett-Packard, founder and chairman of Carly Fiorina Enterprises and Unlocking Potential. Carly, welcome back. Great to have you here. So it's a big tech company, not quite the one that you had with Hewlett-Packard, but put yourself in the C-suite. Put yourself in Jack Dorsey's chairs right now. What would you do with the president really going after your company the way President Trump is after Twitter?
Well, I think first, Jack Dorsey, having made a decision to put the fact-check comment on Trump's claims about fraud and mail-in voting, had to follow through with the next post. In other words, Jack Dorsey was basically announcing a change in policy and saying we are going to try to apply the same rules to the president that we do to everyone else, or at least something close to that. And you can't back off just because the president gets mad. Now, by the way, on the other side, I would say, look, there's a real discussion to be had, and I've been saying this for several years now, that there are a few very large tech companies that have amassed too much power over consumers' lives and information, too much power over an entire industry. And you could put Twitter in that category with Google or Facebook or Amazon, for example. And so, therefore, there's a conversation to be had about whether we need a thoughtful process to think through how to legislate or how to regulate them differently, given their concentration of power. But that process needs to be thoughtful and careful and bipartisan and include the industry. And one thing I would advise industry to do is get engaged in those conversations now, because they're coming. But that conversation does not mean that the President of the United States should, in a fit of pique, fire off an executive order. What he has done is emotional, it's careless, it is incredibly counterproductive.
So, too much power. You've talked about that several times with me, I know, Carly, and there's an issue there about power. Is it a biased power? Because this comes against a backdrop of not just President Trump, but other conservative Republicans saying that, in fact, in social media, there is a thumb on the scale, and that what is good for the goose is not necessarily good for the gander. Do you believe that's true? And let's be honest, this comes against a larger story about Silicon Valley in general. You see Palantir saying we may have to move our headquarters because it's all so lefty out here.
Yes. Well, look, I think there is a argument to be made that the media in general tends to lean more to the left, although there are some obvious examples where that's not true. Fox News, for example. So, yeah, I think you could make that argument. But whether or not you believe that, I think it's irrelevant to whether President Trump, any president, should decide to deal with that through an executive order. If you're going to deal with the issue of bias in the media, then deal with it some other way, but don't fire off an executive order because you got upset.
We can't put ourselves in President Trump's head, but is this a serious effort to actually have regulations passed, or is this a political move, given the fact we have elections up in November? Does this play well to his base as a practitioner to take on the media, as you say, in general, but specifically social media?
Well, I think for sure this latter half of your question is true. I think it is a good political move to fire up his base. I do think it puts Republican elected officials in a very awkward position, because Republican congressmen and senators have universally and unanimously condemned any kind of regulation or legislation over the Internet or any of the Internet-related companies for a long time. And now suddenly they've changed their mind and say, no, we need to regulate or legislate. But it's clearly a good political move for his base, and most elected Republican officials are falling in line, unfortunately. I do not think it is a serious attempt to spur regulation or legislation, because the way in which it was done is likely to prompt a backlash in any event. And that's why I regret this action for many reasons. Because, as I say, I think there is a legitimate conversation to be had about whether there's too much power concentrated in these too few companies. But that conversation needs to be thoughtful and bipartisan, and the industry needs to be engaged in it to get to a productive conclusion.
If you're the CEO of a social media company, you obviously have to be concerned about possible regulation or legal battles, things like that. You also have to be concerned about the court of public opinion, as it were. And I at least have been a little puzzled by the fact that Twitter is not really coming out with the, I thought, basic point that they have not censored President Trump at all. They've put up everything he posted. They just added to it. There's nothing censoring about adding more information to it, but that message isn't coming across. Is Twitter handling this, from your perspective, in the best way it can in terms of communications?
Well, I do think that Twitter has tried to say in the past, although I think you're absolutely right, David, that they haven't been particularly effective in the heat of this moment. But I do think they have said in the past on a number of occasions, look, if this weren't the President of the United States, we wouldn't post him at all because he violates so many of our rules. But we give leeway and latitude and license to elected officials because we think it's newsworthy. That has been their policy. Now we can talk about how consistent that policy is. I also think that it's fair to say that Twitter, in the court of public opinion, is in a bit of a tight spot because the truth is, and by the way, Facebook and all the rest of them are as well, setting aside the question of whether they have their thumb on the scale, it's also true that a whole bunch of offensive, wrong, illegal, dishonest things get said on social media.
No question.
I mean, we all know that.
Yeah, that's no question about it. Carla Fiorina, I'm delighted to say is going to be staying with us as we turn to her new LinkedIn newsletter on leadership and talk about character in a COVID-19 world. That's coming up next on Balance of Power on Bloomberg Radio.
Have you wanted to speak a new language, but you thought it'd be too hard or take too much time? Then go to Babbel.com, download the app, and try it for free. In just 15 minutes a day, you'll be on your way to speaking a new language in just a few weeks. And right now, you can try Babbel for free. Babbel starts out teaching you words and phrases by matching them with pictures. You won't believe how easy the interactive program is. Soon the sentences get a little bigger, and before you know it, you're having simulated conversations voiced by native speakers. And because Babbel is crafted by language experts and uses the spaced repetition method, in just 10 to 15 minutes a day, you'll be speaking the language of your choice with real confidence. With Babbel, you can speak a language. Just go to Babbel.com and start your first lesson in the language of your choice for free. Download the Babbel app or go to Babbel.com and try it for free. That's Babbel.com.
Debbie Hart is president of BioNJ, which represents the interests of more than 400 New Jersey-based biotech companies. She's also a strong voice in the biotech sector, supporting research universities like New Jersey Institute of Technology. She sees NJIT as a valuable partner in attracting venture capital and biotech startups to the Garden State.
So the number one reason the companies come here to New Jersey for the biotech industry is for our talent. We estimate that there were about 30 biotech companies in the early 90s in New Jersey, about 80 in 1998. Today there are more than 400. And that growth continues, and it's come from every possible angle. Other countries, other states, they've spun out of our academic institutions as well as our biotech and our pharma companies, and we expect that growth to continue long into the future. And NJIT is a pipeline for talent, for companies, for entrepreneurs to do that important work.
NJIT, New Jersey Institute of Technology. Learn more at njit.edu.
Are you interested in it? This is a message from the government about the next stage of controlling coronavirus with NHS Test and Trace. To protect your friends and family, testing and tracing must become a new way of life. If you have symptoms, you need to get a test immediately. Don't leave home for any other reason. If you test positive, we will contact you to trace people who you might have infected. From now on, if you're told you've been exposed to an infected person, you must self-isolate for 14 days. Play your part and do the right thing. so we can safely return to a more normal life. Go to nhs.uk or call 119. Stay alert, control the virus, save lives.
This is a message from the RNLI and Her Majesty's Coast Guard. Beach lifeguards can't be everywhere this summer, so they can't always protect your family, but you can. So keep an eye on your loved ones. Avoid taking risks in the sea. Don't use inflatables. In an emergency, dial 999 for the Coast Guard. Get more advice at rnli.org/beach2020. Thank you.
Let's be honest, we all spend too much of our day on social media. But at least you can spend your endless scroll time to discover new things on TuneIn. Follow @TuneIn on Facebook, Twitter, and Instagram to always be in the know about the best new stuff streaming in the app. From breaking news stories and live sporting events.
He does! Fabry wins it!
To standout stations and podcasts. Stay in touch with TuneIn. Are you fully informed on the NBA? On the NBA Hangtime podcast, veteran sports writers Sekou Smith and John Schumann analyze the latest NBA news, storylines, and discussions with guests from around the basketball universe.
Isaiah Thomas joined us here on the Hangtime Podcast. Isaiah, good morning.
Everybody's doing well. As you know, my daughter tested positive.
Search NBA Hangtime on TuneIn to listen.
Buckle up, race fans.
NASCAR is back in the driver's seat.
And you can cut straight to the action here.
With the Performance Racing Network on TuneIn, you can hear PRN's live coverage of some of this year's top events.
As NASCAR's top drivers, Kevin Harvick,
Clint Boyer, and more get back on the track.
Search Performance Racing Network to listen and see upcoming races.
First, we're told that masks don't work. Then, we're told to wear them all the time. One week, we hear that the mortality rate is 2%. The next, well, who knows? In the time of COVID-19, there is so much uncertainty, and so much scientists are learning in real time, along with the rest of the world. So it's hard to know what you can be sure of and what's still a big question mark. Enter Podcast 19 from 538, where we'll explore the evidence behind the science in our fight against coronavirus. I'm science journalist Anna Rothschild. Each week, I'll investigate coronavirus mysteries, keep track of the latest developments on vaccines and treatments. Oh, and I'll try to edit out all the times I shush my family since I'm recording this thing from the chaos of my home.
Search Podcast 19 to listen today.
And breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Stocks pushing lower, bonds advancing as investors weigh the biggest drop on record in American consumer spending. They're also waiting President Trump's latest response in his escalating feud with China. He's got a news conference scheduled for 2 o'clock Wall Street time, 13 minutes from now. We'll have that for you live right here on Bloomberg Radio. New Jersey virus cases rise 0.7% versus the prior 7-day average of 0.6%. S&P down 18, a drop right now of 0.6%. We've got the Dow down 251. That is a drop of 1%. NASDAQ holding on to a gain, barely up now by half a point. Little change there. The 10-year up 9/30 seconds. The yield 0.65%. Gold up 1%, 17.34 the ounce. West Texas Intermediate crude up 0.4%. 33.84 a barrel. I'm Charlie Pellet. That's a Bloomberg Business Flash. Balance of power continues once again. Here's your host, David Weston.
Happy Friday, Charlie. Thanks so much. Character. For some, it may seem an old-fashioned word, but for leaders, it can make all the difference. Something Carly Fiorina of Carly Fiorina Enterprises and Unlocking Potential has written about in her LinkedIn newsletter this week, Leadership Matters. And we welcome Carly Fiorina back now. So, Carly, this is one of my favorite subjects, and I'd say that even if you weren't here, but I'm so glad that you took this on. Explain exactly why you felt a need to write about character this week.
Well, there's an old saying, David, tough times build character. And I don't think that saying is right. I think tough times reveal character. Tough times reveal who we actually are. And I think we're seeing that. I think it's becoming very obvious in the course of this pandemic who is leading and who is not, who has character and who does not, who is focused on serving others and solving problems and who is focused on serving themselves. So tough times reveal character. And the reason character is so incredibly important for leaders is because character is what keeps a leader focused on the right things, which is to solve problems and to serve others, to serve a mission higher than themselves, whether that's a for-profit company or a community organization or the citizens that they represent. Character also keeps a leader going when the going gets tough, and the going always gets tough, because character is about resilience, it's about integrity, it's about courage, it's about honesty. Those things that we tend to discount when everything's going great, and then maybe we get dazzled by flash or someone's popularity or someone's fame or someone's title or someone's big office or big airplane or whatever it is. But when the going gets tough, what we look for and what we count on is character in a leader.
I must say, my experience when I ran ABC News, I was there for 9/11. One of the things I learned from that was you learned about people's characters in a matter of days or even hours, things that would take years to find out.
Yes.
And sometimes you're surprised to the upside and surprised to the downside. But I wonder, Carly, is there anything a leader can do to help develop character, or is it merely a matter of discerning it, looking for it, and finding it?
So first, what a great example, David, of, tough times reveal character. The reason you learn things so quickly in tough times is it becomes crystal clear. I think leaders can set the tone for everything, including character. So one of the ways leaders can encourage the development of character is to be explicit about it, to talk about why it matters, to lift it up, to reward it. It's one thing, character, another way to describe it is how you do things matters as much as what you do. So if you're a leader that doesn't care about character, you might reward, for example, someone who gets great results, even if they're doing it in a way that isn't right. That's happened at a lot of companies where leaders just keep looking the other way. Well, we're cutting corners. Well, we're kind of stepping over a line, but the results are okay, so let's just keep going. That sends an incredibly clear message about character. It doesn't matter. On the other hand, if a leader talks about it explicitly and says, no, how we do things really does matter as much as the results we produce. And we do need to be honest, and we do need to serve others, and we do need to have integrity and resilience and all these things. Then a leader chooses to reward those people and lift those up who have exhibited character. And that sends a message as well that character counts.
Yeah, and the institution figures it out so quickly. Whom you hire and whom you promote up, they know. And every time you promote somebody up saying, well, I don't think they're quite straight, but they're really good at their job, that sends a message to the institution. I heard Warren Buffett say once, when he's hiring somebody, he looks for three things. That's intelligence, ambition, and character. And if they don't have the third, he hopes to hell they don't have the first two.
Well, that's right. And yes, and my less elegant way of saying it from Warren Buffett is people don't listen to the talk. Yeah. They watch the walk. So you can hang a code of conduct on the wall all day long, and you can talk about character. You can talk. But what people watch for is who gets rewarded, who gets recognized, who gets promoted, who gets hired. That's how people figure out, how we do things matters around here.
So let's talk specifically in a case right now, a very important case right now about character and leadership, and that's what's happened in Minneapolis, which, as you've pointed out in a tweet, it's not isolated. There have been 3 of these instances now. And one of the things you say in your tweet is basically, let's think about what would have happened if we had not had the audio and video recordings of the events. We sort of know how it might have played out. What is the character, the leadership that we need right now, whether it's in Minneapolis or in Minnesota or in Washington, for that matter?
At the very end of that tweet, I said, because in that tweet I was speaking to white America, that we need to acknowledge that there's systemic racism, that we need to acknowledge what we know to be true, that if there weren't audio and video recordings, nothing would have happened. Or if the victims had been white, something different would have happened. We know that. We know that. And one of the roles of a leader, another reason character counts, is to see the truth, to speak the truth, and to act on the truth. And that's how I ended my tweet, because I do think leaders now on this issue must see and speak and act on the truth. There is systemic racism in this country. There is a double standard of justice. We've seen it over and over and over again. And I am not condoning violence or looting in any way, but I must say, when people only condemn the violence and don't condemn what has happened to spark the violence, then what do those people hear? What they hear is, oh, you don't care about systemic injustice and racism. All you care about is the destruction of property. We have to see and speak and act on the truth, because as I said in that tweet, this injustice over and over and over again, and all the times that we don't ever hear about and don't ever know about, this is a stain on our character, on our soul as a nation, and it makes a mockery of our highest ideals.
And Carly, I wonder if something you and I have talked about with respect to individuals and institutions applies nationally in this sense. We have known there's institutional racism in this country, whether we talk about it or not, for some time. But in this crisis of the pandemic, has that really brought it to the front? It shows us our character in a way very quickly. And the question then is what we're going to do about that.
Yes. Tough times reveal character. This tough time has revealed our character as a nation. And as a nation, our character is lacking on this issue. And we have to say that and speak it and act on it and bend over backwards, honestly, now. White leaders, white people need to bend over backwards to acknowledge, yes, this is the truth. We must rebuild our character around this issue. And so when, for example, leaders in Washington, whether it's the president or someone else, when they tweet about the destruction of property and don't tweet about the truth that preceded it, that's a problem.
Exactly right. Carly, such a treat to have you on. Thank you. That is Carly Fiorina of Carly Fiorina Enterprises and Unlocking Potential. That does it for Balance of Power for this week. This is Bloomberg Radio, and I'm David Weston. Thank you very much for joining us.
At the start of every... This is a message from the government about the emergency measures to support the economy during the period of disruption caused by the coronavirus. To help you, your business, and your workers affected, you can apply for cash grants, business rate holidays, statutory sick pay relief packages, as well as the coronavirus job retention and self-employment income support schemes. For information, go to gov.uk/business-support now.
Who says you can't have a laugh while getting serious about America's pastime? On the daily podcast Locked On MLB, comedian and baseball fanatic Paul Francis Sullivan talks about each team, each pennant race, and everything else in the game, from rule changes and controversies to baseball cards and stadium food.
For those of you who are not familiar with me or the old show, I love to obsess over baseball. I'm talking baseball over the Super Bowl. We had a TV show in the Division Series during my wedding.
Search Locked On MLB on TuneIn to listen today.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Stay on top of everything happening in the pro wrestling universe with the Body Slamming podcasts on TuneIn. For passionate recaps of the most recent SmackDown to a pro wrestler's perspective on life and culture at large, search sports and scroll down to the world of wrestling to listen.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
Want to relive the glory of college football?
Balls over a man, into the end zone.
Come explore TuneIn's classic game replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 bowl games. Don't miss your chance to re-experience the Rose Bowl, the 2020 National Championship, featuring Clemson and LSU.
There are going to be 2 champions on the field tomorrow night. There's going to be 1 team hold up the trophy.
Pass to the 5, touchdown!
Search classic game replays to listen for free.
Get your daily dose of NFL shop talk with these great podcasts on TuneIn. Start your morning off right with Around the NFL.
Injured, depleted roster into the playoffs, and I didn't think they belonged in the playoffs.
I think overall, though, it was a great divisional round weekend because you got the first one.
Run into the end zone with the Move the Sticks podcast.
We had a fun little Zoom cocktail hour last night.
Oh, yeah.
What a star-studded affair. Greg, you were there for the earlier part, but it really popped off a little later on. We had Zach Goldman.
And dive deep into the sidelines with the Peter King podcast.
On the occasion of his 50th birthday, come down and record a little bit of retrospective on the life and times of Brett Lorenzo Favre.
That sounds like a bestseller.
It sounds like a precursor of a funeral. That's what it is.
I wasn't thinking that.
Explore these and more hard-hitting NFL podcasts right here on TuneIn.
24 hours a day at Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio. This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Jason Kelly on Bloomberg Radio.
Live from New York and New Jersey, streaming on YouTube, TGIF. It is Friday, May 29th, 2020. Shortened holiday week, Jason Kelly, but it felt like we packed in a lot, and we have a jam-packed show coming up.
Yeah, was it a short week? It does not feel like that at all. It feels like we did double time, given everything that's been going on. And it was a full circle week. As you pointed out on our planning call, we started talking about Twitter and the president and China. And hello, here we are again. It's sort of a Groundhog Day kind of week, a Groundhog Day kind of period that we're living in right now.
Deja vu all over again. And we're going to be going live to the White House for a news conference with President Trump. We will take you there as soon as it gets going. Let's get you caught up, though, on the trading day. A little bit quieter than we've seen throughout the week. Let's check in with Charlie Pellet. Happy Friday.
Happy Friday indeed. And last trading day of the month. It's on to June. We've got the S&P down 19 right now at 3,010. A drop there of 0.6%. The Dow is down 250, down by 1%. NASDAQ holding on to a gain, up 8 points, now higher by 0.1%. Stocks pushing lower, bonds advancing. Investors weighing the biggest drop on record in U.S. consumer spending. We're also awaiting President Trump's latest response in his escalating feud with China. 10-year yield 0.66%. Gold up 0.9%. 17.34 the ounce. Crude up 21 cents a barrel at 33.93. That's a gain of 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. And as Carol said just a minute ago, we are awaiting some comments from President Trump. He has promised to give an update on China. A little bit of reporting there that there may be some sanctions geared toward the financial sector. This, of course, all about what's going on in Hong Kong. It certainly has had an effect on the markets this week. So let's set the Business Week agenda with a couple markets experts. Vincent Signorella is global macro strategist for Bloomberg, joining us on the phone from White Plains. He contributes, of course, to the macro Squawk desk. You can check that out at Squawk on your launchpad on the Bloomberg terminal. Dave Wilson, also with us, of course, stocks editor for Bloomberg, joining us via remote line from New Jersey. So, Dave, we heard the numbers from Charlie, a mixed trade today. Put this in the context of this week because it's been, I think this is a technical term, a doozy.
Yeah, I mean, it has been. You know, let's face it, with the S&P 500 getting above 3,000, I suppose the good news is that earlier in the day it dipped below that round number and then managed to bounce back. So it's lower, but not a whole lot lower in relative terms. I mean, what jumps out about today is that, you're seeing technology stocks kind of reassert their market leadership. I mean, they're the best performer among the 11 main industry groups in the S&P 500. And on the other hand, you've got financial stocks taking the biggest hit with all the back and forth related to Hong Kong. Maybe that's not a surprise. Energy stocks, too. And what jumps out there is that, we've seen Occidental Petroleum, which has already cut its dividend once this year, do it again. Brought it down to 1 cent a share. They had been looking at 11 cents for their next payout. They didn't even get that paid, and it brought it down to a penny a share on a quarterly basis. So, it just goes to show you what the oil industry is going through, specifically Occidental with their purchase of Anadarko Petroleum a couple of years ago, and how that has become a real issue in terms of, lower energy prices and the debt they took on for that deal, and having to deal with Berkshire Hathaway's Warren Buffett, among other things, since Berkshire was a major investor in that transaction. Put it all together, I mean, it's just... market's showing some strength, but not enough to move higher.
Yeah, exactly. Vince Signorella, come on in on this conversation. You and I have been messaging back and forth all week, really about what's going on with China. And here we are. We started the week this way, and we're waiting for the president to make some comments. How are you seeing it? What are some of the conversations you're having on the blog?
Well, a lot of folks I've been talking to are wondering if this is going to be as bad as the markets have sort of made it seem over the last 24 hours. The feeling is the longer the president takes to respond, and he could have responded immediately after the House passed, the more that the response is going to be muted and measured, I should say, and that it's not going to be this all-out sort of heavy, hard sanctions situation that markets are worried about. We've had a situation where we've seen China react to what the United States does, and not the other way around. So if we actually respond with heavy sanctions, I mean, the Hong Kong situation and such was a response for the House and Senate passing bills. So if we were to now respond to that, it opens up the door for China to most certainly respond to us. And the weight on the market right now is, does the White House really want to take on a heavy-handed war with China months ahead of an election and months ahead of every member of the House coming up for election?
Well, what was interesting, too, though, Vince? I was hearing a conversation earlier, and I think it was Ian Brenner, and just saying that no matter who was in the White House, they would have had to respond to the actions on Hong Kong, that this was certainly something any White House would have had to respond to. But it does look like it's going above and beyond that.
Yeah, it has that feel to it. It had that feel yesterday. It just doesn't feel as much today. If I were advising the president, I would say give it a measured response, because you don't want to force their hand, make them react to Hong Kong, but rather respond to any heavy-handed action in Hong Kong. And that would give the U.S. and the rest of the world the upper hand. You don't want to make the situation look like they forced China into doing something in Hong Kong and give them an excuse to say, we only did this in response to your pushing us up against the wall. Now, obviously, I'm not advising the president, so I can't exactly tell you what he's going to say in a few minutes.
You sure you don't want to share something with us, Vince? Yeah. Maybe a little side job here?
Some DMs going back and forth between you. He's been on Twitter, I think it's fair to say, so you could just DM him.
I'll give you one little bit of optimism, though, in the data this morning that very few people seem to be talking about. We talk about the big drop in spending, which we kind of had a feel was coming. This big boost in personal income, and I'm going to give you round numbers. We had something like an $800 billion drop in personal income from working, basically. But we had almost a $2.9 trillion stimulus plan. And the anecdotal evidence is that people who were laid off, and not obviously every individual, but as a whole, have made more money and have more income right now than they did before, as we saw the savings rate jump. So going forward over the next 2 months, and this may show up in May's numbers as well, we may see this boost to the economy that everybody has been talking about coming down into the third quarter.
Yeah, that's interesting. And mirrors something that we heard from Margaret King yesterday about, people, the spending is coming back and people are also taking care of some of their debt at this hour.
Want to bring you one headline just crossing the Bloomberg. It's an important one and relevant to what we may be about to hear from the president. The president not planning to quit the Phase 1 China deal. This is according to, as Carol Master would say, a person in the know. Bloomberg reporting that, and that popping nicely on the Bloomberg right now. Clearly, everyone wants to know what happens next with China. Dave Wilson, give us a quick tease for your chart and stock of the day.
Well, as far as the chart goes, it's all about a comparison between growth and value stocks, which suggests growth isn't all that expensive by historical standards. And as far as the stock of the day goes, think housewares.
That's a nice tease. That's a nice tease. I do wonder, I just want to mention, you mentioned that Phase 1 trade deal. Let's remind everybody that what that was is the U.S. cutting some U.S. tariffs on Chinese goods, and then China pledging to buy more of American farm energy and manufacturing goods.
Which hasn't happened.
And also addressing some of the U.S. concerns about IP, intellectual property practices. So that's Phase 1 that's out there.
Right. And it has not gone according to plan by most estimates. All right, gentlemen, thank you so much, Vince Signorella and Dave Wilson. Dave, we'll check in with you later in the show.
All right, let's get to the Bloomberg Business Week Bite of the Day. It's one number that tells us a lot. Today's number is over 0. Is that right?
I believe it is. We'll see.
Costco is bringing back free samples. The CFO telling analysts yesterday on an earnings call that the chain's food sampling stations will begin returning in some capacity in June.
Yeah, the company will start a slow rollout of some form of sampling, but it won't be stuff on open trays, grabbing it with your fingers. Good. And some will be eliminated. Galanti said that the chain's warehouses are still enforcing social distancing and sanitizing, and noted that many food courts have been closed or mitigated during the majority of the quarter. So free samples still available.
Okay. Whew. God, I was getting a little worried.
Why would you go to Costco otherwise?
All right, let's get a check on World and National News headlines. For that, let's check in with Bob Moon. Hi, Bob.
Hi, Carol. A reminder that we're waiting the president's news conference. You'll hear it live here on Bloomberg Radio. A vow today from Minnesota's governor that tonight will not be like the last 2 nights of violence around Minneapolis. This after the arrest of the police officer seen on video kneeling on the neck of George Floyd, a handcuffed black man who died, pleading that he could not breathe. At this point, it's unclear what charges the officer may be facing. Minnesota Governor Tom Walz is calling on hundreds of members of the Minnesota National Guard, meantime, to assist in weeding out the peaceful protesters from the violent ones.
The farthest thing from people's on their minds as they're burning down a family-owned store at 3 a.m. on Lake Street was George Floyd. And that's what we've got to get at.
The governor admits to what he calls an abject failure over the last 2 days. He says tonight there will be no lack of leadership. President Trump added fuel to racial fires today as he threatened to take action to bring the city of Minneapolis under control, calling violent protesters thugs and reviving a civil rights era phrase fraught with racist overtones. He said flatly, when the looting starts, the shooting starts. Trump's tweet was quickly flagged by Twitter as violating rules against glorifying violence. The White House said the president did not glorify violence. Global News 24 hours a day on air and on Quick Take by Bloomberg. I'm Bob Moon. Carol, Jason.
All right, Bob Moon, thank you so much. You're listening to Bloomberg Business Week on this Friday. So, Jason, one of the headlines that caught me this morning and earlier today was Governor Cuomo saying New York City, the last region of the state to remain on lockdown, it could begin to reopen on June 8th. So we are seeing things continuing to move forward. This is virus cases top 5.8 million, deaths over 360,000. Let's bring back with us Dr. Ian Lustbader. He's Clinical Associate Professor of Medicine at NYU Langone Medical Center, a friend of the show, on the phone from New York City. Dr. Lustbader, nice to have you back with us. How's your week been?
Okay, thanks so much. Hope you guys are staying well. Busy week for sure. Seeing a lot of patients who fortunately have been discharged from the hospital with COVID. And we're seeing a number of the sort of sequelae or side effects or people that have been quite ill, some mildly and some more severely with, residual cough, chest pain, abnormal liver function tests. So not everyone gets out completely unscathed, as we've seen.
Right. All right. So reopening.
Oh, wait, why do you let them out then?
Well, if someone is well enough, breathing on their own, doesn't need a machine, people are not kept in until they're perfect, because that could take weeks or even months.
Right.
And it's really not efficient to do that. So as long as someone gets through the kind of acute phase where they're breathing on their own, room air and so forth, able to move around, eat, they may not feel 100%, and they may not feel 100% for a prolonged time. You just can't keep everyone in sort of indefinitely or until there's perfection achieved.
So help us synthesize that, sort of the after effects of this, with what is going to be a gradual reopening of New York City. As Carol said, the last region of New York State to open. What are you expecting to happen in the short term, and what advice do you have for New Yorkers?
So I think we're seeing a lot of people anxious about returning. Certainly, we don't have that vaccine, which we've talked about in the past. That would certainly be reassuring. We're seeing a number of patients with antibodies that are positive, which certainly would help, but nowhere near the herd immunity of 30, 40, 50%. That would be great. So people, I think, are very concerned. Certainly, older people or people at risk groups. But I think most of the patients, most people are just happy to get back, want to get back, and I think a little bit of that is play it by ear. There will be some risks. There will be some probable increase in cases, the so-called second wave. Hard to know how big that will be, because certainly in New York we've had a lot of patients who've had COVID, so it's certainly we have a little bit of a heads up, or a little bit of a leg up in other areas where at least some of the population has antibodies. But I think if you're older, sicker, have a compromised immune system, COPD, lung issues, heart issues, elderly, probably best to be very safe and be some of the last to return to normal activity.
What's interesting, too, that you bring up antibodies. There's a great story, I think I read, it was in the journal or out of Dow Jones, and just talked about the obscure trade of basically blood, that people are looking for the blood of recovered COVID-19 patients. It's become a hot commodity because everybody wants to look at that blood and learn more about the virus. But that's one of the crucial steps, right, in kind of understanding where we've been, where we're going.
Yeah, there's no question that the blood of patients who've been sick and recovered completely is a hot commodity, certainly for convalescent plasma trials that are going on in many hospitals where sick patients are being given that convalescent plasma, and we think hopefully will shorten their illness and hopefully save lives. But that blood is also useful for many tests. All these small biotech companies, some of which are not totally regulated, want those blood samples to run as controls because they're developing antibody tests as well, and research labs. So there's sort of a Wild West scramble for the blood of patients who've done well, really to better understand the nature of the disease, what are the nature of the antibodies, and even just for regular lab testing. So we've seen some blood brokers and sort of the shadier side of biotech occurring, and it's unfortunate because in any crisis you've got people doing well and doing good things. The patients, many of my patients say, I'm so happy I survived. I'd love to donate blood. And they can at the New York Blood Center, where not only blood donations are taken happily, but also for convalescent plasma. So patients who've survived and done well can have that plasma taken out and used in a variety of studies. But there are also bad people who are trying to extract high prices.
We're speaking with Dr. Ian Lustbader, one of our go-to docs in helping us understand this virus. I do want to bring you one headline that has crossed to Bloomberg. The former officer in Minneapolis who has been implicated in the death of George Floyd, he has been charged with murder and manslaughter. That is according to some local news reports there in Minneapolis. Obviously, that has triggered riots and looting there in Minneapolis. It has drawn national attention in many ways. We'll be bringing you updates throughout the day in our world and national newscast, but I did want to bring you that headline because it is clearly top of mind for many of us.
You know, Ian, one of the other things that we're thinking about when it comes to the virus, there's a story also that just talked about a farm in Tennessee where every single worker has COVID. And just, you know, a reminder, I think it was roughly 200 employees that had been infected. Just a reminder that, you know, this is, obviously we don't want to see anybody get the virus, but it also is something that impacts, you know, our food supply chain. I mean, we're continuing to still see some pretty big outbreaks around the country.
No question, and I think people really seem to fall into the cavalier camp, where a lot of young people feel they're impervious or in a low-risk group and are socializing or running around without masks. And then there's another group that's very concerned and mad if they see people around them. I've seen this even in families where different generations take this more or less seriously, and older parents may be angry at younger people for not being prudent and wearing masks all the time, which is difficult. I mean, it is an adjustment. Not everyone has gotten used to that, but certainly we do need critical infrastructure like food supply and others that are safe. And without a vaccine, all we can really do is social distancing and wear masks. You know, and we need to do more studies to see if some medications, we talked about this last week, obviously some drugs like hydroxychloroquine have pro and con data, but we really need those studies. We have to remember this broke basically in January, so we've had 5 or 6 months. It hasn't been with us for years, and it takes time to get these studies done.
That's a really good point. You know, that it does feel like it's been a long time, but it really hasn't been.
And Ian, I mean, I do want to ask, you know, we talked a little bit about this before, but we've talked about this with a lot of heads of hospitals. And as we've discussed, you've been on the front lines of this. And I wonder, for you as a doctor, I mean, how does your practice change in the short and midterm coming out of this? And, you know, setting a second wave aside and assuming that we're going to be able to deal with another COVID outbreak medically. But I do wonder, you know, your interactions with patients, your conversations with them, like, how are you thinking about this going forward, just as a practitioner here?
Well, we're seeing patients with N95 masks and face shields, and that certainly is closer. At least patients are now coming back into the office, which is great. Telemedicine has been very, very helpful, and a lot of patients who really are afraid to come in, they shouldn't, because we're checking temperatures for people coming in. So prudent steps are being done to reassure patients that it is safe to come in for screening, testing, colonoscopy in the office. And it's great to have telemedicine. But there's definitely a bit of a barrier. You know, you're seeing patients you're wearing gloves, you're wearing a mask and a face shield, they're wearing a mask. You know, it is, everyone is adapting, and it's certainly good to be in person, but it definitely is it's getting used to, and you have to make extra effort to really get a good diagnosis and reassure people and encourage them that it's okay not only to come in but to do testing, that it's safe to go to a lab to do blood tests. So there are definitely a lot of hurdles, and I think we're going to see that as we try to get people back in along the way. And I think if there is a second wave, which is certainly possible, that will really be a shock to the economy and to people's psyches, because people don't like to feel vulnerable.
Yeah, I have to say, I had to go out for a routine test, and I was very impressed with the procedures, and they really thought about the patients coming in and were very careful. I was in another situation in a doctor's office where I felt like it's a little crowded, so it was a little odd. I just want to ask you quickly, you've got Florida, their COVID-19 cases up 2.3% versus a previous 7-day average of 1.3%. Is it just because more people are being tested, or is this possibly early indications of a second wave in your view?
You know, I think it's a combination. I think we're getting a lot more tests, and hopefully reliable tests. We talked about those blood brokers. I would stick with national labs that are doing those tests, the antibody tests and the swabs, much more reliable. But I think we probably, especially in Florida, now that once you start getting cases, there tends to be that curve. And I don't think a lot of states have peaked yet. New York has peaked, and we know is coming down, and that's why we're returning. But I think many other states, and I think Florida too, may not have seen the peak yet. And this may not be a second wave. This may just be the first wave that is continuing to ripple through in a state that is more spread out than New York. In New York City, you have a lot of exposure in a very dense area. In Florida, I'm just wondering if this may not be just the natural progression.
Right. You mentioned New York, COVID-19 cases up 0.4%. That's in line with the 7-day average, which has been up 0.4%. So, yeah, there's the differences. Ian, thank you so much. Really appreciate, as always, your insight and love that we get to check in with you every week. Dr. Ian Lustbader, have a good weekend. Clinical Associate Professor of Medicine at NYU Langone Medical Center. Dr. Lustbader joining us on the phone right here in New York City.
All right. Well, we are keeping an eye on the markets and clearly the market trying to figure out what the president may say. We will take you to Washington as soon as the president comes to the podium. In the meantime, let's understand what those numbers look like with Charlie Pellet.
Thank you very much. And happy Friday to you both. We've got the Dow, the S&P lower, NASDAQ is higher. Just one headline, just want to repeat that we brought you. President Trump said to be not planning to quit a Phase 1 China deal. This according to a source. Again, the president not planning to quit a Phase 1 China deal. We are awaiting the president's remarks. And yes, we'll have those for you live right here on Bloomberg Radio. Stocks have paired losses. Bonds advanced as investors brace for President Trump's latest response in his escalating feud with China. The S&P now down by 6. That's a drop of 0.2%. The Dow is down 136, down 0.5%, while NASDAQ is up 44, up right now by 0.5%. 10-year yield, 0.66%, right now up 7/30 seconds. Gold is up 1%, $17.35 the ounce. And West Texas Intermediate crude rallying 2.5% right now, $34.58 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening to Bloomberg Business Week. Jason Kelly, Carol Masser here with you. Sun coming out here in the tri-state area, at least my part of the tri-state area. It's been a little cloudy.
It's been back and forth here, but I have to say I was out before and it was gorgeous.
Yeah, it's really nice. Hopefully a nice weekend ahead. We will be taking you to Washington, where the president is expected to talk about his latest with China. Let's set the stage for that with Jordan Fabian. He is Bloomberg News White House correspondent, joining us on the phone from the nation's capital. All right, Jordan, it's been quite a week when it comes to the president and social media and China. Help us understand what we need to be focused on now ahead of hearing from the president.
Well, I think what we're looking for in this press conference is what exactly is he going to announce in response to this law that China is considering against Hong Kong. We're reporting now that he's looking at targeted sanctions and trade measures in retaliation to that. We'll have to tune in to hear the specifics of what exactly that means and how far he's willing to go to punish Beijing for its moves against Hong Kong.
You know, Jordan, I was hearing earlier another interview on Bloomberg Radio with David Weston where the observation was that any president would be doing this in terms of Hong Kong, that, this just goes above and beyond and certainly would impact our relationship, with Hong Kong. So I do wonder what you're hearing from policy watchers and other folks in and around the Beltway about what the president may do.
First of all, I think what makes this little notable is the president has been loath to criticize China in the past.